Today's video is unlike anything I've ever released. What you're about to watch is an almost 4-hour, 8-part masterclass I created with Dan Flanscha on the academic case for whole life insurance. We originally recorded these as a longer response to many of the arguments made against infinite banking from figures like the Money Guy show. Unfortunately, I'm sad to share that my friend Dan Flanscha has passed away. Dan dedicated his life to financial education and was a CFP, a CLU, an RICP, a chartered financial consultant, and a Life Underwriting Training Council fellow. Education was one of his greatest passions. I couldn't think of a better way to honor his legacy than making his knowledge freely available to anyone who wants it. With that said, let's dive in. Let's talk about life insurance 101. That's I feel like this should be almost 201, but we'll start 101 and then get to the 201 after that. I'm going to hand it over to Dan Flanscha, who's got alphabet soup, been in the industry, probably at the time that this drops will be 40 years, and you have a true love for helping people be efficient with their money. You are a big fan of life insurance when set up properly and how it can integrate with investments. And in your world, a more efficient plan is one that works in as many scenarios as possible to create better outcomes. And with that, let's go into Life Insurance 101. When we met and walked through, what I loved is a lot of times when people do Life Insurance 101, including myself, it feels more like conceptual. And what I love about how you think is you think more academically, which has a place. And so I'm excited to go through this because I've learned things, and I'm sure I'm even going to learn things hearing it for a second time. But I think it's going to be very universal for people, regardless of what camp they're in, if they're investments, insurance, or in both camps, to really understand the how life insurance works. It's almost like a lot of people say, I don't care how the watch is made, I just want to be able to tell time. Sure. Fair. Right. And understanding how the watch is made helps you better appreciate how things work, especially if you're going to help people integrate this into their financial life. So with that, give us the 101 and 201 of life insurance.
Okay. We talked previously about a professional life insurance agent, if they're helping the consumer understand the value of why you would integrate life insurance into planning. To me, it's sometimes helpful for them to understand Life Insurance 101. So maybe it's a style thing, but I think they have to appreciate this. So you cannot, I have no concept of how many times I've shared this with someone in the public. I also, and you know this, Caleb, I've been involved in training hundreds of agents over the years. And
hundreds is what we call a sandbag answer. I wouldn't you say thousands?
I don't know. Okay. Let's be careful about I don't know.
I'll say thousands. He says hundreds. Okay. I'll say thousands.
This is part of the training so there's nothing nothing unusual about this. I will also tell you this. I'm not teaching the course right now, but for CPE for U Colorado, I was teaching a course on life insurance basics and life insurance evaluation. And I included this in that curriculum. Cool. Why? Because CPAs don't understand this. So we're going to back up. And why is it 101? I'm going to get back to this. When you die, you don't get your cash value back. And because you had asked me that question, what are a couple of big concerns, so to speak? And that's one of them that I have in the industry. And until you understand this, you cannot answer that question correctly. So that's part of why I want to back up here. So I'm going to summarize and say this. There really is only 3 ways that you can pay for life insurance. And we're going to break those down. Now, I will also tell you this, that a lot of this is included in the curriculum for studying for a state life insurance exam. So if someone does not understand this and they have their life insurance license, I would have to ask, did they study?
Yeah, I'll keep my mouth shut during this session because I don't want to expose myself here.
Okay, but that's part of why I want to go back to this, right? Because to me, it will resolve a lot of issues. So let's start with this. How do you pay for insurance if all you're doing is paying for it as you go? Now, you'll notice on the graph here, we have a vertical line and a horizontal line. So the vertical line is the price that we're paying that year for the insurance coverage. On the horizontal line, it's the years. So compare it, and we've all heard this that have been in the industry. If you're protecting yourself with annual renewable term or yearly renewable term, what you're doing is you're renting that protection for 365 days. Okay? So after 12 months, what's going to happen to the premium? It's going to go up.
Mm-hmm.
And for those of you who haven't put two and two together yet, why is that?
Because you're 1 year closer to your death.
Absolutely.
Guaranteed.
So the mortality scientists know this, so they've got to raise your rate. So what happens is you'll notice on the graph, your cost goes up with time. Now, I've been kind in this graph. It's a straight line. It's really not a straight line. It's like a boomerang, right? So that's the first way that we can pay for the life insurance. The second way is we can say, well, I don't like that. I don't want my price to be going up every year. What if we raise the price? Could we raise it to a point where it could stay level for the rest of my life? Now, you'll notice on that line, that's depicted with a blue line. And that is technically whole life, because how long are you going to pay the premium?
Your whole life.
For your whole life.
Or the contract will last your whole life as long as it's in force.
Good point. So now let's look at the reality behind this. So is the insurance company charging more for price early on in the contract? Yes. Mm-hmm. They're charging more because somehow they have to compensate for the higher mortality risk later during your life. So you notice here what I've used is the green. So you've got these two green triangles. The first green is putting more in so that it can be paying for the higher cost in the latter half of your life. And so that fundamentally is the only way, the absolutely only way you can keep a premium level. We have to start there. Now, you can also say, well, I don't want to pay for my entire life. Is there something I could do to put a little more in, but at some point have the privilege of stopping the premiums that I put in? So what did I do here? I drew a red line. Now you notice it's higher than the blue line, right? But what happens at some point in time?
You stop paying.
You stop paying. So if we're going to look at it visually in the same manner, now we've also got what we had going on before, but now we depict that extra amount going in for the early years of the contract depicted with the first green rectangle. It's going to compensate for the necessary cost when? Later in the life of the contract. Fair enough?
Fair enough.
Okay, so that's our starting point or our base point. Now, you could argue and say that term insurance, 20 or 30-year term, is some sort of annual renewable or level renew. But the fact of the matter is they're levelizing that premium. So let's go back to what we've already learned. Do they have to raise the initial premium to compensate for the higher mortality risk later in that time period?
So you're saying a 30-year term higher than if you did an annual renewable term?
Absolutely, it will. It has to be because they're promising you a level.
If it's not, that insurance company may not be around in 30 years. So, yes.
Right. So now I've given you the same little green rectangle. So what is the insurance company doing? They're simply charging you a little more up front to offset the higher cost to them to insure you later in the life of the contract. Now, is this a form of whole life?
I would think so.
It's just for a shorter time period.
It's just a temporary whole life concept.
Yeah. And so what you do is you pay the premium based on the time period that you're looking for. It's as simple as this. And Bobby Samuelson, who I know you have an appreciation for, he will say the whole life is the way to levelize the premium for something that has an increasing cost. And I didn't quote him perfectly. That's kind of a summary, but he's absolutely right. That's what's going on here. Now, I think an interesting thing then is we have to say, well, what is the insurance company doing when you're putting that extra money aside? And here's the focus of what, in this particular discussion, I want us to narrow down on. They are building a reserve. They're putting money aside, right? They had to. We looked at it with the green rectangle to offset future costs. Now, what is that known as? I'm going to use the term scientifically. It's a terminal reserve. It's their way of putting dollars aside for later. Now, what do we as consumers know that as?
Cash value.
Cash value. But it's from a scientific standpoint, it's a terminal reserve. And insurance companies are required to put aside terminal reserves. Now, Jason, I think, has talked about this, who you've had on. This is simply premium dollars that have gone in toward a future death benefit, right? And because that reserve is building, it's allowing for that level premium. Now, here's where the confusion takes place. And this is where I want to drive this home. Now, I took this particular graph from McGill's Life Insurance, the 5th edition. And I reached out to them and said, do I have your permission to use this? So I've had to rebuild the graph. So it may not look identical to the one in the textbook, so to speak, but it is as close as we can mimic it. Now, you'll notice on the bottom right, what is it? It's the reserve. But on the top left, it's the net amount at risk to the insurance company. So the first thing you have to understand is this reserve is what is required to allow the premium to stay level. If it didn't, if that reserve weren't there, your net amount at risk, you notice how it's decreasing over time. Mm-hmm. Okay? The permanency of the tool, financial tool, would not work. So let's say in the event of a death, what are you paid? You're paid the terminal reserve, which the insurance company has been putting aside toward the death benefit at, let's say, age 100 when the policy matures, if it's a life to age 100 contract. And they're at risk or on hook for making up the difference, which makes up the total death benefit. So they add on to the terminal reserve, which you also have access to through borrowing, right?
That's right.
They will add to that amount this net amount at risk to them. Now, I've got news for everybody. You're not paying insurance costs on the reserve.
So money that you have in cash value, you're not paying the insurance costs once it's there.
Once it's in a reserve, it's already been allocated to.
So if you have $1 million death benefit and $200,000 cash value, you're only paying the $800,000 net at risk.
Yes. Now, that's crystal clear on universal life, and we're going to get into that. So it will become more evident. In whole life, it's amortized over the life of the product. So you can't necessarily just go in and say, well, how much is the net amount at risk? I mean, it's not all laid out in an accounting format. The key is the same principle is being applied. So one of the things I would encourage the industry, and I know some of them I've heard you talk to, Caleb, is instead of trying to go down this path where we start trying to justify, well, yes, but you've got paid up additions increasing the death benefit, we should be holding our ground and saying, fundamentally, you have to understand this is what allows it to be permanent. It's the combination of the reserve and the net amount at risk. And when you die, they're going to pay you your cash value back because it was like a deposit to the future death benefit, and they're going to pay the risk that they are assuming. Let's leave the paid up addition conversation to a separate topic.
When you say that, you're just assuming level death benefit.
Absolutely.
And in almost every policy that we design, every single year, the death benefit's increasing at a greater rate than what you're contributing. So what we technically say is, yeah, you only get the death benefit, but it's far greater than your contributions plus initial death benefit, which is technically not accurate the way that we described, but the concept is... Listen, like, you can say that as a talking point, but it's a crappy talking point. What you're saying is the idea of them saying they steal your cash value is technically not correct.
It's absolutely wrong. And if anybody claims that, I'm going to get and come back, they don't know about life insurance.
Yeah, I hear you. Yeah.
And I hear people repeat what Dave Ramsey says, and they've probably never studied it.
Yeah. So if someone is saying that, just send them this video. And yes, I appreciate that. Okay, cool.
Okay, so the reserve serves the purpose of keeping the premium level.
I hear you.
Okay, so let's start there. Now we're going to start digging into this a little bit more in detail to understand it more. Let's go back now to these level term products. So 10, 15, 20, 30 are probably the most common. So what the insurance company does is a review. They raise the premium slightly to keep it level. And we know they're doing that. When they do that, they set aside reserves early in the contract to offset higher costs later in the contract. Over a 30-year time period, the likelihood of premature death is going to increase quite a bit, right?
That's right.
Now, so we know fundamentally they're having to set aside reserves.
Yes.
So here's the million-dollar question. Are they allowing you access to those reserves?
To a term policy, no.
No. In a whole life, they do. Now, some of these all came about with development of the non-forfeiture provisions, driven by consumer demand, insurance competition, government seeing fairness. But the beauty of a whole life contract is you have access to collateralize that terminal reserve.
Whereas in term insurance, you do not.
You don't get it.
Right.
So you're buying the same thing for a shorter time period, but you're giving up one potential feature that you just can't get.
Yes. And of course, term is going to be way cheaper than whole life, like you covered, because one is lasting your entire life.
Yes.
Always the technical language is amortized over your entire life. Right. Whereas the term cost is over a temporary time, and the insurance company would not give you that term if they thought there was a high likelihood of you maturing, dying. Do you know, I've seen all kinds of stats around term insurance payouts. A lot of people say 2%, but I feel like they're just pulling that out of like a bad ChatGPT. What's the actual, like how much term actually pays out? I
have tried to dig into it too. And I've not gone so far as to go to like LIMRA statistics, but I think it would be fair to say it's in the 1% to 2% range. And I think if we just stick with that, that's fair enough. Okay.
Yep. All right.
That would cover us for different time periods too. All right. So now let's get into life insurance built on a universal life chassis. And here's where I think it's one of the benefits of this product is being able to dissect these things and better understand it. Mm-hmm. Now, you'll notice this graph here. I have drawn this by hand. Now I could say in the thousands.
Okay, there you go.
Okay. Now, why do I say that? I was weaned on universal life. It was like a baby calf drinking milk.
And you shared with me last night that you had a whole life.
Yes.
That you transferred to a universal life back in the day.
Yes.
And so this is not just, not only do you know this, but it's personal because you told me that if you could have done that differently, you would have.
And I have whole life today.
Yeah.
But I still have that UL contract.
Awesome.
And I wish I didn't. Now, keep in mind, this is the original universal life. So we've had 3 developments since this original founding. Let's just say it happened around 1980. And so universal life, the basic universal life, the investments are the general account of the insurance company. That's all it is. Mm-hmm. So rate of return that's credited to the policy, you'll notice that I describe that as interest up on the top right of the pot of money here, so to speak. On universal life, that's just what the insurance company has been able to earn on the general account and pay you back in terms of interest. Now, in terms of everything here becomes very clear. Remember Brian and Bo? All the fees and expenses. Now we see where that language is coming from because universal life is built on an accounting principle. So when you look at any universal life annual statement, you're going to see a ledger with columns. You can go left to right on that. You're going to be able to say what premiums were paid, what fees came out of the premium, what interest was credited, what cost of insurance was charged. You see where it's aligning with all of these things. So we can break them down and we can actually see them disclosed on a typical annual statement for the insurance policy. This is where the language comes up, again, going back to Brian and Bo talking about fees and expenses. So I'm going to step back and say, we have to ask ourselves the question, are Brian and Bo evaluating whole life, which is supposed to be what infinite banking is based on, or are they using universal life? And I don't think we ever do figure that out.
Yeah, and to be fair, someone looking at it that's not like really in the nuts and bolts, maybe they misspoke, but both insurance contracts have drags to it. And it would be easy to say that those drags are fees, and what you're saying is technically in whole life, which infinite banking is based off of, doesn't have fees. It has
an amortized cost.
But
yeah.
The non-academic watching that is like, you're giving me lawyer vibes right now because you're so I'm totally with you. And no matter what you call it, it goes back to the dividend, return of premium, but dividends also become tax-free even if they return more than your actual premium. So there comes to a point where language can be important, but also language can be used to gaslight people. Not that you're doing that. I just want to reason with the person that might be like, yelling at their at the screen right now.
I think the point I want to drive home in all of this is we've got to be very careful when we do something like watch a YouTube video and we start to glean or draw assumptions from that when it's not going very deep.
I understand.
Okay, fair enough?
I understand. Yep.
All right. Now, let's get back into this net amount at risk thing, because I think this is important, because it starts applying to many different things when we have conversations around universal life. By no means going to get into all of that in our time together. But the fact of being able to look at it on an account principle and look at the different parts is helpful to understand better, I think, this net amount at risk factor. Mm-hmm. So we have this terminal reserve in the pot. We call it cash value to the consumer, right? So if you have $1 million death benefit, you have $400,000 of cash in the policy. What is your net amount at risk to the insurance company? $600,000. Yep. What are they charging you mortality expenses on? $600,000. Now, we've hit on it a little bit. As you get older, is the cost to insure you going to remain level, go down, or go up?
It's going to go up.
Okay, it's going to go up. So if that net amount at risk never changed, what would happen to your total cost of insurance charges on that universal life contract?
Would increase.
That would increase
pretty significantly.
And that's why so many of the universal life contracts issued in the early 80s are scheduled to lapse. Now, what do I mean by lapse? They're going to get to the point where there's no money in the pot, no cash value, and the insurance company has to go monthly and pull the cost of insurance out for that month. What if there's no money in there? Policy lapses. Mm-hmm. So it's important to understand this. So now let's almost ask a rhetorical question. In order for the total insurance costs in the contract not to increase over time, what must happen to the net amount at risk over time?
It has to decrease.
It has to decrease. We're going right back to what's important, the terminal reserve building in the background to keep what? The premium level.
That's right.
Okay? Now, this is a little bit of a side story here. I wanted to talk about it sometime, but I didn't know when. I was in a leadership position with a Fortune 300 company, and we had hundreds of thousands of original universal life chassis-based products on the books. We went through a 3-year initiative to meet with everybody who had universal life whose policies were scheduled to lapse. And I'm talking about thousands of people. So there was a tier 1, a tier 2, and a tier 3. So tier 1 was those that were scheduled to lapse sooner, and so on. All right, I was responsible for overseeing that project. Now, let's think about this. So we know enough now to say, okay, that cash has not been growing fast enough in there to reduce the net amount at risk. What am I going to do to compensate for the problem? Now, I'm older now, right? So time has been working against me. Cost of insurance per $1,000 of death benefit is higher today than it was when I took this contract out. So here's really the only three or four options. I can put in a whole lot more premium.
Which is an option that very few people want to do, especially if they feel like it's underperformed.
Yep, it is an option.
Yep.
Number 2, I could reduce the total death benefit. Because if I manually reduce the death benefit, what have I done to the net amount at risk?
You've decreased it.
I've decreased it. Or I could do a combination of those two. Mm-hmm. And we found in many cases we could shore up contracts that was something that was more livable. Now, what is another option? Surrender it.
Yeah.
I mean, you have the right to
Or
1035
it.
1035 it. You could move that terminal reserve or cash value into another product. But now we're still dealing with the same problem, right? It's now like I'm buying brand new insurance and I'm 20, 25 years older than I was when I bought the original one. So in essence, what I'm having to do is increase the premium just like I would have to do on this to shore it back up.
Yep.
Now, we have to ask ourselves, well, why did this happen? Well, first of all, it's interest rates. When this product came out in the 80s, what were interest rates paying?
Higher than they were now.
Yeah, I sold a lot of this with 11% more interest.
And you felt like you were probably being conservative.
Oh, we would run illustrations at 8%.
Yeah, just like 8%.
Because we were being conservative. There's a theme here you might catch on. Maybe not everybody, but there's a theme here with that comment. While we're being conservative, guess what that product interest rate dropped to?
Less than 8.
4%.
Yeah.
The guaranteed amount under the contract.
Yeah, that's a bummer.
So if your cash value is not growing enough and this whole thing turns against you, now there's other problems too. Would it be possible to increase the death benefit and not increase my premium? On universal life, it's possible. Is it possible that I borrowed money and didn't pay it back? I withdrew money and didn't pay it back. So we start to run into all kinds of behavioral issues too.
Right.
The bottom line, though, is it is dependent on that reserve growing.
Yes.
That's the message I want to portray.
Can I ask a question regarding, we'll just say index universal life as an example, because that's a lot more hot right now than UL, but it's using the annual renewable term chassis. One of the things that a lot of whole life people will say is there's more levers and the company can change things up on you. Now, in a capitalistic society, you wouldn't necessarily want to do that if you want to stay competitive, but from an insurance company standpoint, I would imagine they have a lot more outs in a universal life product than a whole life, because isn't whole life, it's built on guarantees and they're amortizing their risk, net amount at risk from day one. So there's not like, even if you're stuck with it, the thing that you can do is bring dividends down to 0, but you're still stuck with that promise. And if someone acquired you or they're still stuck with that core promise. Whereas, is it true that a universal life contract, number one, it can go up and down in a competitive environment, but let's say an insurance company just says, Dan, we screwed up. Like we're over our heads. Could they just make it unbearable and make you either cancel it or transfer it out? Like, is that, we're not even talking ethic, like, do they have more options out? Like, if I was an insurance company, I feel like a universal life, if I'm thinking about myself, gives me way more optionality than whole life. Because whole life, I'm kind of committed from the day one. And universal life gives me a lot more flexibility. You could even say that as a good thing. I could say we're going to get more efficient and we're going to be able to provide a better offer. That rarely ever happens, by the way. I could say that, but I could also say I could make it unbearable if I wanted to and get some of this bad business off the books. Part of my question making sense, like, in your opinion, can that happen, or is that just a talking point that a lot of whole life people use to potentially scare people away from not thinking about IUL?
Totally. And I've lived it.
Okay. So you've actually seen this happen.
Oh, absolutely I have. I've been around the block a few times.
Yeah.
Okay. Now, so let's dig into this a little bit. And you use the word, what is the biggest benefit of universal life on any chassis over whole life?
Flexibility.
What is the biggest curse of universal life? Flexibility.
Well, I'll push back. I would say, just based on my talking point, it's the flexibility to the carrier.
It's both.
Yeah.
Consumer will abuse this.
Yeah.
The insurance company will use it.
Right.
Now, I've heard the arguments too, Caleb. I mean, in a capitalistic society, the insurance company needs to remain competitive. They don't want to be harmful. That lever on cost of insurance can be moved just ever so slightly.
Yeah. Or
it's not going to come to the attention of...
One of the insurance companies that I started with, was Ohio National, and they demutualized.
Yes. And
most of the clients, including myself personally, 1035 out of there, because even with a whole life, what they were doing to that company, it wasn't competitive. And yet they still had to keep their promises. Now that what they're paying on dividend is embarrassingly low,
Sure.
like, it's embarrassing, but they still are locked in to their core promise. And there were some people that decided to stay. Maybe it was from a health standpoint, or it was just hey, we looked at the guarantees and we're doing this from a death benefit perspective and we're still happy with it. The point is, if that happened in a universal life contract and the company pretty much, I'm not going to say that the company just wants to get this stuff off the books, but they clearly are not trying to be competitive to keep that on the books. They could hypothetically, and correct me if I'm wrong, they could just say, screw you. And they probably wouldn't say that in letterhead, but
we need to look at it in a broader picture.
Okay.
First of all, we have current cost of insurance, that lever of the mortality cost. They also have maximum cost of insurance. So under the contract, that company can only pull that lever so far.
They can't go to the moon with
No.
it. Okay, so there's capping that. But they can also bring down the interest rate caps as well.
Well, if we're talking equity index, you will.
Yes, index universal life.
And if we're talking about the cost of option, we're a whole nother subject. Let's stay focused on just the COI.
Okay, cost of insurance.
Cost of insurance. So the way you paint that picture is almost like they're pulling out one individual consumer and say, we want to get rid of them.
No, they can't do that.
They can't do that. We know that.
It has to be on blocks of business.
But let's say they pull that lever just ever so slightly. Do they know that statistically, okay, we've just increased our lapse rate by age 85 by 10%, and we just took X number of million of death benefit off the books? Can they control that? Absolutely they can. Now, I'm not saying that they're going to be malicious, but I'm going to share a personal story. Remember, I was in charge of looking at this Tier 1, 2, and 3 program for an entire region. I left that position. I was back in Colorado. I was presented an annual report of an elderly lady, and I saw the documentation who had gone through that review program and the steps that they took to shore it up. And I don't remember if it was an increase the premium, reduce the death benefit, combination, whatever. It shored it up. It probably would have lasted to age 100. Her new illustration showed it lapsing much earlier. And I started looking at it, and I determined the only thing that could have changed is the insurance company pulled the lever a little bit. And guess what? That company announced record-breaking profits that year. Great publicity, okay? So I can't prove that. That's what I saw on the street.
Yeah.
Now, companies, and this I believe wholeheartedly, some companies will take a block of business. They will keep it open for a period of time. They will close that block of business because it's been sold off illustrations. They close the block and they can adjust the cost of insurance ever so slightly, and it becomes more profitable to them. They open up a new block. Now, again, some will claim that doesn't happen. I think I've seen enough to believe it does.
And the reality is, many companies wouldn't want that to happen if they want to stay competitive. You just have to think long term.
Yes.
And 20, 30, 40 years, different leadership changes, different environments change, and it goes back to the philosophy of why you're buying insurance. Are you buying insurance to outperform your investments? Shame on you if that's what your goal is. And if not, then why are you putting yourself in a product that has more variables? And I won't put you on the spot. I'm not saying a universal life chassis is wrong across the board. I just think it's way oversold. Yeah. And it gives a lot of people talking points when it comes to these horror stories, because it happens on whole life as well. But
sure it does.
it would absolutely never be the case if you sold a bunch of whole life for you to have Tier 1, Tier 2, and Tier 3 of people that were going to have their policies blow up, because by definition, that would not be able to happen.
We're still seeing the ramifications of it today with vanishing premium whole life.
Oh, interesting.
We are. Because vanishing premium was based on, back in the 80s, a certain dividend scale, building a certain amount of value, and then starting to...
Is it premium offset, essentially?
Yeah, starting to surrender PUAs to pay the premium.
Oh, interesting. Okay.
Yeah, every once in a while I get notices of it's going to tank.
Interesting.
So it can happen with whole life.
Which would not be possible if you reduce paid up a policy, but that wasn't a reduced paid up. They were surrendering dividends, which at the time of selling it was a lot higher. Dividends went down, and now the policy, that was
known as vanishing premiums.
Yeah,
so it's not perfect on the other side either. What's an overall theme here? Consumer beware.
Yeah.
And it gets back to, who's the life insurance company in business for?
profits for their shareholders, and they would say the policyholders if you're a part of mutual. So I'll give them the benefit of the doubt. How would you answer that?
Customer number one for any business is the business.
Yeah.
It's not you and I, period.
Yeah.
And I'm not saying that's wrong. If they want to stay in business, they want to be profitable, they have to be customer number one. But we have to acknowledge that. So if we go into all of this understanding that, we have to be aware of what their capabilities are with these things.
Right. Cool. Is there anything else that you want to mention when it comes to Life Insurance 101?
Well, this is a picture here of showing you net amount at risk and how it decreased over time, but then it wasn't increasing fast enough. And so that because the cost of insurance per $1,000 of amount at risk started increasing, it couldn't keep up with what was coming in. So what do you notice with the cash value here?
Dipping.
It's starting to go down, and now we see that net amount at risk increasing. So we would now go into, Caleb, a whole discussion about dividends in another part of the video. So maybe it's a good time.
Okay.
All right, let's transition a little bit here now and go back to just focusing on the whole life. Because one of the things that Brian and Bo get into is this fairly in-depth discussion about dividends. Now, that is applicable to a whole life product. It is not applicable to universal life. So again, now we're hearing them talk about whole life. Sometimes it seemed like they were talking about universal life. But I think it's important to understand a little bit more about these paid up additions, because it's a very important part of the infinite banking process, and you have to understand how it's designed. So let's start with the concept of how a dividend is earned by the underlying base insurance policy and what can be done with it. That's our starting point. Now, remember, we talked about let's keep this separate from the conversation about the terminal reserve and keeping the underlying premium level.
I hear you.
All right, so now what we're talking about, but yet on the other hand, is now we have the opportunity to have an increasing death benefit. And inside of every additional purchase of insurance through a paid up addition, you're guess what? Going to have a terminal reserve and some net amount at risk to the insurance company. And they're buying a paid up addition knowing there's enough terminal reserve in there that you never have to pay into it again. So what is it? It's a one-time premium payment into a very teeny whole life policy.
Okay.
Right?
So if someone were, if I would ask you, define paid up addition to me, how would you define it?
It is using the dividend that a company pays from efficient operation of the business, and that you earn that dividend by participating in the efficiency of the operation of that business, and now you get to use that dividend payment in a number of ways. So paid up addition is just one of them.
I understand, but people can actually pay from their own pocket additional PUAs.
We'll get to that in a minute if you're okay with it.
Yeah, absolutely.
Okay, so let's just briefly, because I want people to understand there's more than one way you can use this dividend. You could just receive it in cash.
That's right.
In fact, there are times it may make sense to use that dividend to go outside of the contract to start purchasing something else. As an example, I could put the money in an account at the insurance company to what's known as accumulate on interest. So think of it as a savings account. It's an account you're going to get a 1099 and have to pay tax on every year. You know, I have never seen anybody do that. Period. I have never seen it happen. I could also use that dividend to come around and reduce my premium. Say, I want to use this to help pay the premium. I could use that dividend to buy a 1-year term insurance policy on top of everything. I could use that dividend to make loan repayments or apply toward borrowing against the insurance company's general account using my cash value as collateral. So when it comes to infinite banking, one of the principles is using that dividend to buy paid up additions, right?
Mm-hmm.
I mean, we're both on the same page there.
Yep.
Now, it's important to understand that that dividend is being produced by the underlying contract. So you have to wait till the contract starts producing a dividend and then select what it's going to come back and you want it to do for you. And believe it or not, and we're creative as human beings, we say, I like those. I like those paid up additions. Is there some way I could take money out of another source? Maybe it's my checkbook as an example. Would you let me buy some more of those paid up additions?
I see.
And that's the whole concept with infinite banking in terms of being able to accelerate the amount of money that is put into the contract to build faster cash values. Now, you have to, and I've got this graph, and I know this is a complicated graph, but you notice how I've set it aside? That is money coming from a different source.
Yes.
Now, you may be paying for it in the same billing practice.
That's right.
But it's money technically coming from an outside source, not waiting for the contract to produce it.
I see.
Now, you notice, what do I have in there? The terminal reserve.
Yep.
And what happens to the paid up addition? I've got a stair step on it too.
Mm-hmm.
So the accelerated paid up additions I buy with outside money, I purchase with outside money, they're also going to grow, aren't they?
Yes.
Yeah. So now I've got the base contract paid up additions growing, and I've got what I put in accelerated paid up additions.
I love it. I love how scientific you are with that. I've never had someone break down PUAs in that way, and I love how you started with, first and foremost, it's a dividend option.
Mm-hmm.
And then this became, and I would imagine there was a day that no one paid extra money into PUAs, and then something happened where it was like, oh, could I put extra money in form of PUAs? And now it's very common for at least us to include these type of riders and options for people to, when we talk max fund, overfund
Yes.
policies, you're using a heavy version of PUAs for that.
And infinite banking relies on being able to put as much of these in as you can. I personally believe, and you know this, Caleb, there's a whole spectrum of this.
Right, yes.
Where these can be used through a different spectrum of planning techniques.
That's right.
So now I want to take this and take it one step further, because Bo and Brian got into some returns on the insurance. And I think it's important to understand what they're claiming versus truth. So let's go to the next slide here. Now, I picked up on this, and I think it was Bo that said, he made the comment, Consumer Reports says that your internal return is only 1.5% typically, and he made the comment something to the effect, and that includes dividends. So I thought, that could have been a flub up in a recording. We all make mistakes when we're recording live, right? So I wanted to dig into it a little bit. So I went to their website, and I have for you what it says. Consumer Reports has estimated the annual rate of return for whole life insurance is at 1.5%. Now, let's break down. I went back to that Consumer Report. What does it say here?
Guaranteed cash value.
The average annual rate of return is 1.5% for whole life guaranteed cash value. It's the terminal reserve inside that base contract.
Yeah.
Okay. Now, what does it say? Well, it goes on to repeat talk about other yields, right? Now, what if you are max funding?
Yeah.
You're putting in extra into this paid up additions that come from outside sources. What are you going to do with that internal rate of return?
It's going to increase. I have even more questions, like what type of insurance companies did they pool stock companies that have non-competitive whole life? Because even if you didn't include any PUAs, your IRR on whole life is going to be more than 1.5 if you're working with a reputable.
That would be an interesting one for us too. In our interest environment today.
Yeah.
I would say, take me back 30 years ago, I wouldn't have doubted you a bit.
Yeah.
But I've looked at enough of these recently, because I'm not just focusing on that guaranteed value. I'm not so sure Consumer Reports is that far off.
Okay.
Now, the date is 2015.
Yeah.
Okay. But we have to understand the important role of paid up additions. So why do we even just stay focused there? It's a good starting point.
Right.
Again, what is it? It's a terminal reserve to get us to the end point.
That's right.
Period. That's what it's for.
Yeah.
So I was just on a webinar a couple of days ago with repricing of some whole life. The IRR in terms of putting in more paid up additions, what is an effective internal rate of return was around 3.25 to 3.75.
Yeah. Sounds about right.
So now what you're doing is you're blending the performance of the underlying plus the...
I understand.
Okay?
Yep.
Now, we're going to have a conversation about what does that mean in the outside world.
Right.
But we're starting to get to the point where we're becoming competitive, let's say with a bond portfolio return. Fair enough?
Fair enough.
Okay. Again, some of the things, and maybe we can wrap up with this particular thing, is focusing on some of the language that I want you to pay attention to as you have the privilege of watching Brian and Bo's video, okay? So let's review this. Terminology with whole life insurance, not with universal life. Dividends, direct recognition loans, non-direct recognition loans, guarantees that are associated with cash value. Now, here's all the kind of language that we find on universal life chassis that we typically aren't seeing on whole life. So I'm just, again, drawing home the point, we really don't know what they're evaluating here. And they refer to cost of insurance rates and almost allude to it always increasing. I'm going to go back. Do cost of insurance rates increase per thousand as we age? Per thousand net amount at risk, do they?
Yes.
Yes. Do total costs of insurance raise if net amount at risk is decreasing? Not if the net amount at risk is decreasing fast enough to offset the cost per thousand.
Yes, that makes sense.
So you cannot just blankly talk about, well, on this insurance, cost of insurance is just going to
be
keep. No, not if it's being designed correctly, okay? Yes. That, I think, is the message that I wanted to leave with this.
All right. Life Insurance 101. I think we delivered on Life Insurance 201 as well.
Oh, did we?
I think so.
It's not in my 201, but go ahead.
I love it. All right. So the next thing that we're going to talk about are some must-reading material for people and some of your biggest takeaways on some of the top books that you've read on life insurance.
Yep. Fair enough. Sounds good. All right, Caleb, the focus here on this particular recording is I wanted to just suggest some readings. If someone really is going to be a professional in the insurance industry, a life insurance agent, I think it's important to look at it from a number of perspectives, and I'm going to say glean an appreciation for what we're dealing with here. So I've just put a number together. I have read hundreds and hundreds of books, and you can glean from all of them, but here's some that I thought would be helpful. So let's just spend a little bit of time talking about them. I'm going to start with this. It's pretty basic. I think you should go back and look at what you studied to pass your life insurance exam.
Don't you? I love it, yeah.
This whole thing on terminal reserve, I mean, if you've missed this, you're missing something.
Okay.
Dave Ramsey had his life insurance license. Where did he miss this? Because he missed that part of the studies, evidently. The second one is this, and I've mentioned Solomon Hibner. He was known as the father of life insurance education. That's how the American college got started. His book, The Economics of Life Insurance, I think is a must read. Now, what he builds in that case is the methodology for determining human economic life value. So what he developed is what's used in court of law to determine in a lawsuit what the value is economically of someone's life. It was used in the settlements after the World Trade Towers were collapsed. So when you walk away from studying Mr. Hibner, you will just have a better appreciation of our industry and the value that we bring. And it brings it back to some very fundamentals. Let's forget about all the little intricacies for a minute. Fair enough?
Fair enough.
So I would suggest that's a tier one read. The other, and this one is pretty recent on my reading, and it was Bobby Samuelson that put me on to it just last year. And I thought, this is interesting. So I found it and I ordered it. What you glean from this is a long time ago already abuse that we saw going on in the insurance industry. Are we immune to greed in the industry? No. And again, I think it helps to understand where insurance companies are coming from. And I think we're doing a better job today through regulation, through accountability, through the credit rating agencies, and men, and it was men, that stood up a long time ago and were getting shot at by insurance companies. I don't mean literally with bullets, but they were taking the heat, and they were standing their ground to make sure that our industry remained professional. Let's put it that way. So that, I think, will give you some
These would be 3 must-reads if you really wanted to take this profession seriously.
Yeah, it gives you a better perspective of the entire industry from a high level. So now let's get into what I'm going to call Tier 2. And these are things where we start breaking it down into different approaches. Now, they're in no particular order, and in any one of these readings, you're going to learn a lot of things. What I tried to do is pick out 1 or 2 things that are more emphasized. If you look at all of these different systems out there today, they all tend to focus or put more energy into one thing. And here's the problem. It's hard to help a consumer understand only so many vantage points, okay? You and I know there are many things, but so let's summarize a little bit. The first is the book Lifetime Economic Acceleration Process by Bob Castellone. Now, over time, I would say that Bob settled in that the primary focus of LEAP is talking about 1X planning, and that means having an equal amount of permanent death benefit at retirement to be able to spend all your other assets and enjoy them. So let's just start there. Bob also addresses lost opportunity costs quite a bit, and in fact, in the planning software today, the current version, I would say that's the primary focus in terms of testing different scenarios. Fair enough?
Fair enough.
So you come to it and you learn more about those things. Obviously, Nash's book on infinite banking. Now, I put velocity of money. I think it also maybe could be a little bit differently described with Nash in terms of cash flow, available capital, that kind of thing, and the fact that we finance everything we purchase. So again, there's a lot of other things we could get into, but that helps you to start to understand this segment of our profession. The third is The Pirates of Manhattan by Barry Dyke. Now, why do I bring that up? Brad Coyle in Salt Lake says, well, do you want to know what the big boys are doing? Because they've done all the math, and the big boys are buying whole life insurance. And what he's talking about is all of the bank-owned life insurance and the corporate-owned life insurance in America. In terms of the bank, it's a Tier 1 asset. It is an incredible tool for them. They understand the value of it. Why don't we? Okay? Good. So that's an important read, I think. Now, it's basically driving that 1 point home. Mm-hmm. This is big in terms of corporate America. How did Enron set aside a lot of money for the execs? It was business-owned life, corporate-owned life insurance.
And they're still getting that to this day?
Yes.
Yeah.
So it can be abused too, right?
Yes.
But it can also be used in very valid situations. The next is The Personal Economic Model by Don Blanton and Dr. Copeland. Now, I would have to say that I'm betting 99% of the words came from Don Blanton. That Dr. Copeland was put on the book for notoriety, being at the American College. So that's what I think it is. It's Don Blanton's material. But I think he does an incredible job of talking about and building a case for what is the ideal asset to collateralize. I don't think anybody's done it better than Don. Now, when you look at this list, again, there's always different focus. Don's focus is a little different than those of us who've been trained under LEAP. It's different than those who've been trained in infinite banking. And some of that, too, is, again, how much can you cover? So those are the books that I would suggest. I have one other comment, and that is, and I think in when we put all this together, is that Brian talks about, well, I've never heard any of this on social media, basically.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean, my head's spinning a little bit on this. So, because this is not anywhere that I'm seeing on social media.
And my encouragement is none of us are. you got to dig into this stuff and learn from the sources, right? Social media isn't going to get into these things. So my encouragement to Brian is study,
My
Brian.
goal is to prove you wrong long term, because I want to create platforms that bring people on that, but you're totally right. Like there's a sense of you have to dig in, and there's a sense of I do believe social media is just a form of communicating.
I see what you mean. You want to prove me wrong about social media.
But
yes.
yeah, TikTok.
Yeah,
I mean, there's only so much you can do in a 60-second, 2-minute video, and a lot of times you're keeping it conceptual. You're talking about the key points, and you're missing maybe the true nuts and bolts and how something works.
It's a great point. And now we're giving Brian the opportunity to go on to a YouTube video and study.
Yes, maybe he'll watch this.
There we go. Good. Okay.
So Dan, is it fair to say this next section, when we're talking about the retirement, we're going to be looking at and studying how life insurance integrates with retirement planning and the pros, cons, and the results?
Absolutely.
Okay.
It is the core of, I believe, evaluating what we've been hearing here.
Lovely.
So we're going to approach it from a totally different angle.
Cool. Most people, when it comes to investing, advisors, they are talking about retirement planning. Like
Sure.
Different philosophies, different ways to skin a cat, but at the end of the day, we're all really trying to optimize this thing called retirement. And so what you're saying is really understanding this section is going to be key. And we talked earlier about the different things about how much someone gets paid. And that's a good point to push back on a talking point. But I want to go on record to say I don't actually care how much you get paid. I care what results I get. If someone gets paid $150,000 versus someone that gets paid $50,000, it's almost the equivalent of like, I don't necessarily care about that. I care about me when it comes to that. And maybe the person that's getting paid $150,000 gets a better result than the $50,000. And so with all of that, I'm really hoping that we can define what does winning look like in this phase. And I know that you have articles. I also know that we're going to be pulling some video clips from Brian and Bo. Yeah. And so without further ado, let's talk about this.
Okay, so we're skipping forward. So traditionally we look at financial planning having 3 phases. Now this is accepted by the Financial Planning Board. Is you've got the accumulation phase, you've got the distribution phase, and you've got the conservation phase. We're skipping right through accumulation basically, and we're going to retirement here. Now, there's all kinds of reasons to have the life insurance during accumulation, but keep that in mind. We're jumping to retirement. So we're going to go back to this comment about he who has the biggest pot of money at retirement wins the game. Furthest could be from the truth. So if you start hearing language about, well, if you did this, you're going to have X more dollars, we're going to dig into that because it goes far deeper than that. So we're going to look at the philosophy of Brian and Bo, and I want to just summarize a couple of things that they've said, and you're going to hear them say it. But life insurance is a period certain need. You become self-insured. That is absolutely correct. You do become self-insured, and you're financially independent. But I'm going to add at the end, at what cost? And then another comment they make, term insurance is for a certain period of time, and that's why we basically recommend term insurance. So you'll hear them say that. Now, to start the premise, I want to introduce you to a concept I've developed based on reading and understanding and looking at someone's household economically. Now, when I say economically, I'm not referring to what's the economy? Are we headed toward a recession? No, I'm talking about the economy of a household. And when we get eventually to talking about lost opportunity costs, I want to drive home what I define as 3 separate projects. So we're going to be squaring them away and evaluating them through these research articles. So what's project number 1? Project number 1 is evaluating where do we stand the day before retirement. Okay, so we're going to assess that. And number 2 is the day after retirement, what's it going to produce for income? And project number 3 is what do things look like the day after death? In other words, the conservation phase, where we're now distributing things to the next generation. It is the inheritance, if you will. So with that in mind, because we're going to be coming back to those things periodically, that's an introduction to the 3 different projects. Now, what I want to do here is set the stage for what are the 5 primary tasks for any retirement plan. And you've got them on the screen, okay? The first one is to provide an acceptable standard of living for life. Now, I want to define that as such. You pick one person out of a couple who is the main retiree. And this is important because when it comes to holistic planning, we have 2 people involved. So you notice the second point is provide income for surviving spouse's lifetime. So what happens is we're looking at efficiencies. You have to separate those 2 because when we start bringing in other tools other than an investment portfolio, there's all kinds of opportunities that we can start interjecting because somebody's probably going to die first.
That's right.
Okay?
Yeah.
I mean, statistically, that's what's going to happen. Number 3 is you have to have an emergency fund. The need for an emergency fund is not going to go away. Number 4 is paying for ongoing unexpected expenses. Now, the industry would refer to these as financial shocks. I'm going to cover the first, what I'm going to call the 2 main ones, just to give you a taste for what these are. The first one is this: needing financial support to pay for the assistance of living.
Yes.
Okay, so it's whether it's in the home, it's being taken care of during the day, whether you need to move into some sort of a facility to get assistance more ongoing. You get the picture.
Mm-hmm.
That you have to consider that, or it's not a retirement plan. The second one is this: it's supporting children who are in financial need. And that statistically, I'm not going to get into it, but it's more common than we believe. It's a choice of whether you want to do it or not, but you have to consider it. And number 5 is pass on an inheritance. Now, there are people, we've all met them, that could care less about passing an inheritance on to the next generation. But I'm also going to say this: if you plan with efficiency in mind, the net result is you are going to pass on money.
You're right.
The reality is, why don't you start giving some thought to what you want to do with it?
And the reality is, it's just like legacy. Someone's like, I don't believe in legacy. Well, everyone's going to have a legacy,
Yeah.
you know, so just like inheritance, there will always be something. It might not be much, but it could be, you know, as little as maybe some clothes that you still have to a massive estate. So there's still some type of inheritance.
Legacy could be things like values. And,
Right,
yeah.
right. And so when you're saying the 5 necessary tasks, provide an acceptable standard of living, that's obvious. That would probably be what most people think about. Income for surviving spouse. So if I die before my wife, I want to make sure that she's taken care of. Serve as an emergency fund, because life happens. Pay for ongoing unexpected expenses, and you gave a few examples, and then pass on an inheritance. And so when you're doing a retirement plan for someone, these are like the 5 inputs that are going into a model to figure out how we help optimize.
That and in my head, and I'm talking about it with them.
I love it. Cool.
Okay, fair enough.
Continue. Yep.
All right. So this leads us down to, well, if you're only looking at an investment portfolio, you're asking the investment portfolio to do all 5 of those things, period.
Yeah.
And I'm going to ask the question, this is a very simple generic question. Is there any way one financial tool can be good at everything?
I think the answer is no.
No.
That's the right answer on the test, by the way.
Yeah. So if we say the investment portfolio is going to do any of those things, all those things. So again, we're going to share another clip with you. Brian talks about, well, at least if you have the investments, you're going to have assets when you pass away, and you're going to be able to leave those to the next generation. But again, I'm going to come back and say, at what cost? Okay?
Now, we need to be completely transparent, though. Age 66, the life insurance gone with this term.
It does.
The cost of insurance is going to be so expensive
exactly
now because the underwriting is going to have to be done again. You would probably just not be able to afford the life insurance. So that $1 million will disappear.
Yep.
But I mean, it's one of those things when I saw this case study and I was looking, I was like, but that's okay, because realize, as we showed in the best case scenario for the infinite banking, the death benefit would be $896 and the cash value would be $532. You don't get to keep both.
No,
you only
it's
get either or. So the only way you get the $896 is if you die.
That's it.
Versus at least with the investing, buy term, invest the difference, you at least now get to have the assets and then use the assets, and then your heirs get the assets later. You don't have to die to get the higher number.
So with that in mind, now we're going to start moving into these 3 different articles. What I'm going to do, I think, Caleb, here is just kind of summarize the articles and then get into some specific findings that I think will drive home the point that I'm trying to get across. It's all kinds of articles out there. I think these are 3 very good ones. I'm going to also say this as a caveat with anything where people are bringing things like this to the table. You could look at these articles and you could argue until we both die about what rate of return assumptions were used as an example. Right. We just have to set the stage for why the case was built as it was and learn from it as we can. So what's the first one? It's an article by Dr. Pfau, Optimizing Retirement Income by Combining Actuarial Science. Now, I actually had the pleasure of, right at the tail end before this one went to market, so to speak, or published, Dr. Pfau had me review this.
Wow.
So it was pretty cool. So anyway, and then I heard him speak here shortly thereafter on the article. It came out originally as a white paper. You can see where it came from. Now, let's talk a little bit about the article. This one of the 3, I think, is the truest balance of letting insurance products do their thing for what they're designed to do, more than the other 2. It focuses on the value of mortality credits. Now, mortality credits we pick up when we pool our money and scientifically distribute it back to ourselves through the process of pooling that money with others. And you receive your principal, your interest, but you also earn something that's known as a mortality credit because of your pooling money. The insurance company, again, knows some people will die sooner, some mid-range, some later in life, okay? It is utilizing life insurance primarily for death benefit. As we start moving into these other 2 articles, we're going to see a move away from that. So I would also say that, to me, this is the most coordinated approach in the 3 articles, okay? Now, because what he is doing is implementing both annuitization and life insurance, and they both involve mortality. One is covering premature death, and one is covering living too long. I'm going to call that a mortality straddle.
Mortality straddle, I like that.
Okay, so I've just introduced that to the industry because in the investment world, we have options straddles.
Okay.
With using puts and calls. This is where we're putting mortality science on each side of the fence, so it's a win-win no matter what happens. Okay, we can talk about that at some point perhaps. All right, I also like this, is that the cash value of the life insurance can be used as simply a backup strategy. So we haven't talked about the compound interest curve yet, but the longer a curve, what happens? The more the accumulation. So if we're letting the cash value in the life insurance accumulate long term, it serves as a wonderful place as a backup strategy if we need to. Okay? I'm going to focus on median investment performance as we review this and the others, meaning kind of where are we middle of the road with investment performance. So let's talk about the second one. Now, integrating whole life insurance into a retirement income plan, emphasis on the cash value as a volatility buffer asset. Now, what do we mean by volatility buffer? If you're withdrawing from a portfolio known as the SWIP method, that's the scientific name for it, the withdrawal method, where you're simply taking a withdrawal from the portfolio every year to produce retirement income. When markets are down, and there's all kinds of different ways to approach this, but when markets are down, where do you go for that year's income? You pull it from the life insurance, and then you let markets recover and then go back to the investment portfolio. Now, I have done scenarios on this. If you can get 6 to 7 different years of income, of volatility buffer, it's not too hard to increase the standard 4% withdrawal rate to 6, 7, or 8.
So, in saying another way, if you had 6 to 7 years of volatility
Available
of income, you could, with the same certainty, increase instead of 4% to 6, 7, or 8%.
Yep.
Okay.
Now, what makes this beautiful, because the main study started on this with home equity as the reverse, as the volatility buffer.
Mm-hmm.
So those are the two tools accepted today as ideal volatility buffers. So if you start combining the reverse mortgage with this, you suddenly, now again, see, we're coordinating.
Yes, integration. How dare you? How dare you talk about other things in one
It just suddenly
conversation.
explodes your opportunity.
Yes.
All right. So that is going to be the focus, although what happens in this article is they go back and basically repeat what Dr. Pfau did in the first one and add a couple of variances to the withdrawal using the buffer. Fair enough?
Fair enough.
Okay, now we're going to go to number 3, and this is the one that I would say is the least coordinated. And why is that? This is the one that simply looks at the other products as a rate of return tool.
I see.
Okay? So I'm going to just summarize a little bit. So if that's your approach, is squeezing out another 0.5% or 2% internal rate of return on that product, that life insurance product, important?
Yes.
David McKnight.
Yes.
Okay? So David has referenced this particular article. So again, we're tying in philosophy and how we're
So
using
you're saying this last article by Philip, is it Ferrari?
I don't know how you pronounce it. It would make sense.
And you're saying that they're talking about insurance and investments, but instead of looking at all the aspects of insurance, they're looking at the internal rate of return and then asset, and that's about it. They're not factoring in other things like death benefit and all?
No, the death benefit will come into play with legacy planning.
I understand.
Okay? But it's very acceptable to push the insurance to a max in terms of getting as much out of as you can to be able to produce the most retirement income. So it gets back to, so it becomes, can I get more rate of return?
I see.
Okay? That's a theme that I'm going to portray in the overall analysis of these. So I think what's important is we break these down, and I'm going to get into some numbers, Caleb, but I think it's going to help us understand what this is teaching us. So let's go to article number 1. Okay? So what I'm going to call the baseline. The baseline is you buy term insurance and you invest the difference. Sound familiar?
Yes.
Okay. The second one is we're going to take a coordinated approach. We're going to take whole life. Now we're going to take the difference and invest it in investments. Same strategy that we were doing before, but now with a different insurance product. And at retirement, we're going to implement a single premium immediate annuity to produce income. Okay? So we've just introduced 2 more tools into the equation. When we've gotten the term insurance is gone, we're implementing the whole life. Now, how am I going to approach this? The day before retirement, the day after retirement, and legacy. Right? 3 projects.
Yep.
All right, so let's dig into this a little bit. Now, we're starting with median investment in returns. I'm not going to talk about when investments perform bad. We're not going to cover that. Let's just assume over time to start, people experience reasonable rates of return.
Yep.
So I'm comparing number 2 against number 1. So we're looking at the approach of incorporating some insurance tools.
Mm-hmm.
The day before retirement, that couple has 16% less assets.
Okay.
Any surprise?
Yeah, because their insurance products are going to grow less than investment products if you're in this model.
Yes. Now, There's a lot of other factors that could unfold there. They
Yeah.
have more assets with the insurance. But
Yeah.
for right now, all we're doing is just saying, let's just let the insurance move along steadily. Now let's look at the second project. Number 2, the people with whole life and being able to implement the single premium immediate annuity. And why can they do that? Because at the husband's death, the life insurance will replace the amount of money put in the single premium immediate annuity. It gives them 36% more income.
Okay, so the day before retirement, they had, you said 16%
Less assets.
less assets. So if someone were to look at that, what do you want, person A or person B?
Yeah.
Any person that's looking at the numbers with no other context would say, I want the one with more money.
Well, isn't the whole idea of retirement planning
Yeah,
based on how you set the stage?
right. But then if you ask that same survey the next day, 2 days later,
Right.
and you say, okay, what do you want to rather be? Would you rather be the person with this income or the person that has 36% more income? Almost everyone.
Is gonna say-
and what would be interesting is majority of people would assume, because it's a great assumption, more money equals more income. It's very interesting.
Yep. Okay, now let's go to the third project, the day after death. So the legacy. The person with the insurance, not buy term and invest the difference, 47% more legacy at age 100.
Almost 50%.
Yep.
Oh, wow.
Now, let's back that up a little bit because we've got time horizon here. If that person had died, both of them were gone the day after retirement, 16% less 16% less legacy. Why is that? They had put money in the annuity, and when you're gone, you're gone. And it only paid one death benefit based on how this scenario is set up. So it's not efficient for legacy if death for both took place the day after. But over time, it comes back, and it's far more efficient than the investment-only approach.
I see. Yeah.
Okay? Now, let's take this and let's look at it from a standpoint of you got super lucky with your investments.
Mm-hmm.
It's what the top 10% in terms of an investment experience. So you got lucky. What's the likelihood of that happening?
Oh, 10%?
I don't know from an investment standpoint.
Well, you said top
Let's
10%. So
10% of performance.
Okay, I see.
Of outcomes.
Okay.
Okay, the day before retirement, 13% less assets for person 2 with the whole life. That's less than the other one.
That's interesting. So you're saying if the investments
perform
better, the investment to whole life ratio is actually smaller.
Yeah, we got to think about a couple of things here. This one surprised me too, and I'm not going to dig into it. But what happens in a taxable environment when you've got investments performing better that have not been taxed yet? Because this is 401k money. So the analysis is evaluating the wealth after tax.
I see. Okay. Because logically, that would not make sense if you didn't factor in taxes.
Absolutely.
I understand. Okay.
Okay.
Cool.
The other thing that we have to consider is that the people who are buying the whole life also are getting better investment performance, but not as much of it is accumulating inside the 401k. Okay, so the person got lucky with their investments. Guess who had more income the day after retirement?
Person with whole life?
Yeah, 9% more.
Wow.
Maybe not huge, but I'd take a 10% increase in income. Now, here's what's interesting. Is the legacy is 25% less for the person with the whole life. So it's a negative. Now let's think about that. What happens in the compound interest curve? So we've got somebody from 65 to 100.
Right.
All right. And they haven't passed away, and this is an evaluation at age 100. That compound interest curve inside of
skyrockets.
Is skyrockets. So this makes sense. But I'm going to say, looking at overall, using this particular scenario, which strategy is more efficient?
It's the one that gives you more income in either scenario. And the legacy is an interesting point, but you're also assuming a really, really great run, and then you just ask your clients, do you want to bet on something for 25% more legacy over here, or do you want to have greater certainty of income and no matter what happens, it's going to happen. And I'm curious. I didn't see these notes. Did they also run a bad scenario, like a bear market scenario?
Well, they did the bottom 10%
Okay.
performance.
Okay,
And I chose not to get into it.
But that would really highlight the power of life insurance.
Oh, it does.
It would be
Yeah.
it would be overwhelming to be like, oh man.
I just want to take it off the table because of the public's argument.
I understand.
Everybody feels their investments are going to do better.
In a bear market, you could potentially even make the argument that the insurance part would outperform the investments, which is a crazy statement to make. Even if it didn't, everything that we mentioned in the middle study was life insurance would be enhanced legacy income and probably the net worth difference.
To summarize, the day before retirement, the investment approach
In the best case scenario.
in median or best.
Okay, yes.
But the day after retirement, the income analysis, they're better off with the whole life. And the only time they're better with a legacy, with the investment only approach, is when they participate in supermarkets all
whole
through
time.
life.
Yeah, that's
So, I mean, what's the
Yeah.
likelihood of that happening?
yes. And so that's a summary of optimizing retirement income by combining actuarial science that Dr. Wade Fowle did, and you had the pleasure of seeing it before it got published.
Yes.
That's awesome.
Okay, let's move on to number 2. And there's actually 5 different scenarios in this particular one. I'm going to focus on only 3.
Okay.
So we set the stage, same first baseline, in buy term and invest the difference. Number 3 is using the insurance as a buffer asset. So we're going to use the safe withdrawal method to produce retirement income. When markets are down, we're going to pull money out of the life insurance.
Yep.
And all the compensation is done to equate for tax ramifications.
Yep.
All right. Now, number 4 gets into combining 4 different products. The investments, obviously, whole life, the incorporation of a single premium immediate annuity, and a buffer strategy.
Interesting. Okay.
Okay. So we're getting more and more complex here. Now, the reason I chose this one is they're only going to allow withdrawals from the insurance up to cost basis. So we don't even have to get into the idea of loans.
Okay.
In the 5th scenario, and I'll comment on that just a little, they actually are okay driving the insurance in the ground, basically.
Okay.
Keeping it still in force, but driving its value out. Okay? So number A, scenario I want to compare is, again, median investment returns. So we're going to compare the buffer approach to the buy term and invest the difference. Now, the day before retirement, the buffer strategy has 13% more overall value. Kind of a surprise.
Interesting.
Yeah, it is a surprise. Now, the day after, 30% more income.
Wow.
And 32% more legacy at age 100. How can you go wrong?
Right. Yeah. Yeah. It almost sounds too good to be true.
Right. Now, because the investment portfolio is performed the same, we're using the same portfolio returns and the life insurance performance. We're going to look at combo 4, where they do buffer single premium immediate annuity, but the total assets are the exact same as they were in the previous one. That combination is 13% more of total wealth the day before retirement. We're going to buy that single premium immediate annuity at retirement. 54% more income.
Wow. And it's fair to say you have more income, but you have less liquidity.
With
of
the SPIA.
With the immediate annuity.
Yeah, and buying the immediate annuity. Only 10% more legacy.
Okay. But still, there's still more.
Still more. Now, if you did number 5, which is the one where I mentioned that they basically allow the life insurance to eat itself up using up to cost basis and then loans thereafter, 62% more income.
Wow.
You see where this is going?
Tell me.
How can you begin to argue that incorporating insurance in your retirement planning doesn't make sense?
It would be really interesting, and if I do get the opportunity to sit down with people like Brian and Bo and even Dave Ramsey, it'd be interesting to how I could articulate this in a way without trying to attack them, but laying out what is your thoughts on this research? Maybe maybe they haven't taken time to read it. Maybe they haven't taken time to study it. I'll give them the benefit of the doubt. But why aren't CFPs like drilled into, like if you're a fiduciary, if you're a CFP, wouldn't you, and you're a planner, wouldn't you be like very aware of something like this?
Yes and no. Depends on where you spend your time and energy and you're poking around. Again, remember what I've talked about, what I've observed in the CFP community. Very unlikely. Now, Dr. Fowle's spoken in Denver at the CFP.
I see.
But that's usually not going to be the case.
Okay.
And you start looking around, what are you exposed to in terms of stuff that pops up on your computer, articles that have come out?
Yeah, very little of it.
You're not going to see this come to the forefront as much if you're operating in that investment silo. The reason I also made the comment about rate of returns is I think it's always easy if you're only in the investment silo to go back and start arguing the rates of return that were used here.
Yes.
That's the easy argument.
I see.
But again, there's no, how do we know what they're going to do?
Right.
And I think Dr. Fowle builds a pretty good case for what numbers he used and why.
See. Okay.
So,
and then the last, or is there more to
yeah, I wanted to go in this one into the top 10% of investment rate of return. So again, remember, this is the getting lucky. Things happen to perfectly work out in your favor. So what we're going to compare here is, again, using it as a buffer to only the investment and buy term approach. The day before retirement, only 1% more in assets, but 32% more income.
Yeah. I think when you say those numbers, and that's significant. 32% more in income.
Mm-hmm. Legacy, 20% less. Okay. So because we are heavily relying on that life insurance as a buffer versus, remember in number one, Dr. Fowle is relying on it more for the death benefit.
I see.
Okay. So I think we can start drawing some conclusions about what's more efficient. I'm going to come back and say, let the tool do what it's best at doing. And what is life insurance first and foremost best at doing?
Protecting your life.
And paying a death benefit.
Yes. Yes.
Okay, so next with the 10% investment in the top tier that got lucky, we're going to look at number 4, the one where we're incorporating investments, whole life, SPIA, and buffer.
Okay.
Against buy term and invest the difference. Again, only 1% more net worth the day before retirement. Nothing's different than the first one because we haven't implemented the SPIA yet. 48% more income.
Almost 50%. Almost.
Yes. Oh, I see this all the time. It's not hard. I'm going to tell you, with integrated planning, it's not hard to take somebody from 80,000 of income to 110, 120.
Wow.
It's not hard. But you got to be willing
to use other products and integrate
products
them.
And look at the total balance sheet. Now I say, what is the total balance sheet? Every asset I have, including my house, and what tools I can incorporate using all the assets I have at my disposal.
That's when you talk about household economy. It's looking at the whole household. Yes, love it.
Okay. Now in this case, 47% less legacy.
Okay, so you're taking more income, but you're taking a massive haircut on legacy.
Yes. Now, but keep in mind, we go back to that compound interest curve on the investments all the way out to age 100.
Yes.
So that's probably the biggest one that's impacting the legacy.
Yeah, the other one, if my memory serves me well, was 25% difference. Just in summary, someone could do the buy term and invest the difference. They would still take less income, significant less income, but if they stuck the course, they would have a higher legacy than the person that had whole life and all. Okay.
If investment returns worked out.
In the top 10%.
Yeah. Okay. Yeah. So most of what you start seeing is, in terms of what's promoted, is the got lucky approach.
Right. Yeah, and what would you rather bank on? The got lucky approach or the approach that where it goes back to your definition of efficiency is what's the thing that's going to work in every scenario?
Mm-hmm.
And even though, this is what's crazy, is even in the great scenarios, like great scenarios, whole life option gives you more spending, even in the you got lucky scenario. And then it just comes down to legacy. And there's some people that care deeply about legacy. The irony is, if you care deeply about legacy, that's the last thing that you want to do is put all your money in investments. So it's just, the irony is very interesting as you lay that out.
Okay, we're going to go into number 3 here, which is, as I mentioned, going to start taking these products and relying on them more for a rate of return. So this is a one that David McKnight referred to recently, and it makes sense because he's looking at the indexed UL product, and the idea that perhaps over time you can earn another 0.5 or 1%. And given this philosophy, that becomes important. But now let's see what the reality is. All right. So I'm going to call this an accumulation play, because in this particular research, before we hit age 65, they have the consumer purchase a fixed indexed annuity in some cases. So why are they doing that? They're doing it because of that ratcheting feature on increased income that automatically takes place over years owning that fixed indexed annuity. Okay, and that becomes a whole other subject.
We're can move on due to time, but
yeah.
Clarify anything that you think needs to be clarified with what you just stated.
In many fixed indexed annuity products today, there's the real account, which earns whatever it earns, but then there's also a fictitious account. And this fictitious account, it's not even an account, it's just a math calculation. And that number in that fictitious calculation is increased every year, and that number is used to determine how much you can withdraw for a lifetime off your money.
I see. Yep.
Okay?
So they're using that type of product within this within the study.
That's why they're having them buy it, I think, at age 55.
I see. Okay.
Okay, so here's scenario number 1. Is 80% of the money going in investments, 20% into indexed universal life. So this one's pretty simple, right? That's all we're doing. Now, what are we going to do with the universal life? We're going to be withdrawing from it.
Yep.
So internal rate of return is important. Guess how much more, I'm just going to focus on income and legacy here. Guess how much more income this one produces versus an investment only? 0.2%.
Really?
Why are we even bothering with the IUL from a standpoint of income?
Yeah.
Okay.
It's interesting.
5.7% more legacy.
So doesn't necessarily move the needle much.
No. So I'm coming back to there's more efficient uses of the insurance, and it's the death benefit. Okay. Now I'm going to move on a little bit. Now, instead of indexed universal life, we're going to implement the fixed indexed annuity. No universal life, indexed universal life. 80% into investments, 20% of the portfolio at age 55 is put into a fixed indexed annuity. 16.4% more income. So what are we doing? We're leveraging mortality credits for income.
Right.
Okay? We're using that product for what it's good at doing. 0.1% less legacy.
So legacy is a wash.
Yeah. Now, why is that? I'm going to summarize in saying this, and this research will prove this too. This done by Dr. Fowle. Why is the legacy diminished with the use of the FIA? It's because of the cost of the product, and it's the cost you're paying for that mortality risk to the insurance company that you won't run out of income. So from that vantage point, it's not efficient.
From a legacy standpoint, but is it essentially a wash?
It's essentially a wash, and you got what it was designed to do, and that's income, gave you income. Now, I want a caveat that I haven't stated yet is that I purposely chose different percentages to keep this simpler.
Okay.
Because they ran scenarios and all kinds of different percentages. I chose these because I looked at which ones did the best, as Brian and Bo would say, trying to give them the benefit of the doubt.
Okay.
Okay, so now we're going to do 40% in investments, 30% into indexed universal life, and 30% into a fixed indexed annuity.
So you're doing investments, annuity, life insurance.
Yeah, and again, the FIA is purchased at age 55.
I see.
13.9% more income.
Okay.
10.9% more legacy. So we're picking up a little more efficiency here.
When you're integrating those products.
3 products instead of 2. But again, I'm going to come back to, is it anywhere close?
Yeah.
To what we started seeing by true coordination.
And what we've talked about earlier is they're using IUL in these scenarios. And so you're also adding a lot more variable. You're based on assumptions, but of course they're basing off of, I would imagine, safe assumptions on an IUL. I wonder if they're taking, it's hard to know what
they will go and they will state in the article, I just don't have it memorized,
Yep.
what data based on recent performance that they're pulling from. So All, I think, good research. They're
Yeah.
building their case for why they used what they wanted.
You would think, though, that the IULs would outperform whole life in this type of study, but that's
We
not.
don't have whole life here, though.
I know, but you like in
Oh.
Dr. Wade's Fowles research kind of
Because
deal.
he's using it more for death benefit.
I see. Yeah.
It's what we're using it for.
Yeah,
and
I
again,
see.
if we want to withdraw from it, we want to chase that rate of return.
I understand.
Okay. Now, what's interesting is the author, and there's actually graphs in here like the efficient frontier of investing. The author put together efficient frontiers of combinations of these products.
Yes.
I mean, this is serious stuff. It's not just he who has the biggest pot of money
Yes.
at the end of the rainbow the day before retirement won the game. Now, real quickly, I'm going to get into the 45-year-old. They did
Okay.
research on, because everything I've been doing so far is on 35-year-olds. I don't think I stated that. I kept it consistent. Most
Okay.
of them are 35, 55-year-olds. This case, it was a 35-year-old, 45-year-old, and 65-year-old. Not going to talk anything about the 45-year-old, but I'm going to summarize this. In all of these articles, do you think efficiency improves as we wait to do this later in life, or decreases?
Decreases.
It decreases. So I'm going to come back to retirement planning as part of accumulation planning.
Yes.
And it starts when you're in your 20s.
It's this stuff becomes less attractive if the day before retirement you're trying to implement.
Correct. So let's talk about the 65-year-old and just bring in a couple of quick things. Now is when they also bring in this idea of a single premium annuity
Okay.
versus a fixed indexed annuity. So scenario number one is 40% into investments. They also bring in Social Security only at full retirement age, FRA, 30% into the IUL, and 30% into fixed indexed annuity, 5.5% more income.
Okay. Something.
It's something, but certainly not what we could pull off looking deeper. Number two is 40% into investments, also Social Security at full retirement age, 30% into indexed universal life, but now we're going to switch it out and we're going to use 30% in a SPIA instead of fixed indexed annuity. 48% more legacy. That's the one I want to focus on.
Well, how much income?
I didn't
Okay,
I
you
didn't
didn't
want
run-
to point on that.
Okay.
I don't remember what it was.
Okay. I would imagine it would be more income than the FIA. A SPIA.
It probably is, depending on those ratcheting
Okay.
factors.
But you're saying almost 50% greater legacy.
Now, why is that?
Well, it's because you're using the life insurance for what it's intended.
Yes and no. Here's the key factor, and this is separate research done by Dr. Fowl. When you start incorporating SPIAs into your investment portfolio and use them to replace the bonds, what happens is the remaining stock portfolio is allowed to do what it's designed to do, and that's grow long term. And so you would think, well, taking some of my money in a SPIA that I could give up if I died the next day,
Yes.
yeah, you may be right, but long term, your legacy is going to be better with the incorporation of the SPIA because you're letting the investments grow.
Do their thing. Yes. That's well stated.
So, again, implementing various tools. So, what if I were going to summarize all this? What am I saying? I think the proof in this research says, number one, that you can do much better in retirement income planning and legacy planning than simply using an investment-only approach, along with all the other considerations that would go with that. And number two, if you truly allow the tools to do what they're designed to do. Remember I asked you that question, can any tool be good at everything? Why don't we leverage what each tool is the best at doing and let it do its thing?
Seems like that should be the proper planning paradigm.
And that gives us the most
Do
efficiency.
you see the environment of financial planning changing to get more like this? Like, do you see with this research? Because, I mean, the latest study was in 2025, but like some of this stuff has been out in 2015, 2019. We haven't really seen much from a paradigm shift, but have you seen, like, do you think this is going to start changing the way that people think?
When you're viewing it in the insurance silo, I don't see that much of it coming to the forefront in the investment silo.
Okay.
There's got to be an element of it, but I'm sure just not picking it up as a theme,
I
a
see.
major theme.
It'll be interesting to see over the next 5-10 years
It will be.
if there's more people that go this way or if it's just going to be pushed off.
My hunch is you get into, family offices where you're getting a higher net wealth and things. They're obviously looking at these things.
Mm-hmm.
But the average consumer that's worth $500,000 that's going down and having a meeting with the local certified financial planner, this is a generalization, but I just don't see that much of an impact on that community.
And when you're incorporating insurance and annuities into investments, there's more complexity. And so it's, going back to show me the incentive, I'll show you an outcome. Sometimes it would just be easier to say, yep, your portfolio looks good. I'll see you next year.
Where I will give the planning community credit is there's been a large expansion of the use of annuities.
Okay.
In fact, there has been a trend, and it makes sense, that the manufacturers, the vendors of these products, have designed annuity products that do what? Pay a fee on assets under management.
There you go. So speaking their language. That's interesting.
So it also has gone with.
Cool. Thank you for summarizing the retirement. The next section is going to be on lost opportunity cost.
Oh, wow.
Very excited about diving into that, and I think that we're gonna get people thinking. That might be an understatement.
Makes me think too.
Yeah. We're talking about lost opportunity cost, and when we originally chatted, I was on the same page with you. Good. And then you said something about death benefit, and that's where I physically pushed back, and you kind of lit up, and you're like, it's almost like Yoda, like, I have a lot to teach you, my young Jedi. And so I want to, again, take a step back. I have an open mind, but I also will push back and ask questions if I see that, because I do feel like I have a understanding of what someone could comment, and I'm trying in the type of content we make is to try to articulate both sides, because that is the way that we're going to break into more groups of thinking. And so with that, if people are not talking about lost opportunity costs, I really do think they're missing the boat.
Mm-hmm.
And when I learned about this concept of opportunity cost, of like every decision you make has ripples, and it's not just losing $1 here, but it's what you could be earning over there. It's just like, it really helped me think differently when it comes to money. And it's the thing that's, I would say, if I had to give like you 2 words around how I think about wealth, it's opportunity cost. It's just like, that's such a profound aspect. And so before we jump into this, how do you define opportunity cost?
Well, in just a minute, we're going to look at 3 definitions.
Okay, perfect. All right.
So why don't we hold off and we'll do that. I'm going to be the first to admit, this is for me the hardest concept to get my brain around. Let's maybe start this way. Does gravity exist?
Yes.
How do you know it exists? Okay, so you've got proof.
Some people would call this density, though, so I don't know.
Okay. You can't see it.
Yeah.
You can't see lost opportunity costs. They are there. So we can choose to ignore them, or we could choose to acknowledge them. Now, because it's such a hard thing to get your arms around, why do you think traditional financial planning just ignores it? But it's probably the one reason why it's so hard to get ahead financially. So I think it merits spending some time on it. And we're going to look at some quotes here from Bob and Don as well. Now, Brian makes the comment, when lost opportunity costs are factored in. The problem is, we never see an example of lost opportunity costs actually being factored in. Right. So we're going to do that here by taking a look at, a case, and we have that built out by them. What are the facts? A 30-year-old in excellent health. They talk about a $500,000 term insurance policy at $188 a year times 30 years. So we know that the total premium over the 30 years was $5,640, right? And they compare it to a $4,015 a year whole life premium.
Yeah, if you look at how much insurance coverage costs, and this is for a female in excellent health, for a $500,000 policy, if you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188.
Now, at its face value, anybody would look at that and say, well, that's so obvious. Which one's cheaper?
The term.
The term insurance.
So these are very different when it comes to costs of getting.
But we have to also acknowledge right up front, we're only talking about premium here. We are not talking about true cost. So now what I want to do is I want to start digging into what is lost opportunity cost. Now, because this is so hard to get your arms around, I pulled a definition from 3 different sources. So the cost of doing something is measured by the loss of the opportunity to do the next best thing instead with the same amount of time or resources. That's one. Number 2, which we're going to use as our definition, an investor incurs an opportunity cost equal to the rate of return that could be realized by investing elsewhere in other projects. Could be investments or savings, other financial vehicles or instruments. And that is the definition taken from, you'll notice the notes down here, the Schmodies at the University, the School of Mines.
There you go.
All right, in Colorado.
Yes, sir.
Now, there was a father and a son that they both have been professors, and they've wrote textbooks on evaluating taking one business adventure versus another one. Now, when they teach students how to do that, what do you think they're incorporating? Lost opportunity costs in the analysis. As a side note, I had a CPA who was one of their neighbors, and I tried to get an in to go, could you introduce me? I want to go talk to him. It didn't work. Okay, the third one is taken from this textbook, Fundamentals of Financial Planning, and that was a book I used to study through a business called Insurance Achievement at that time. All right, so if you look at that definition, the value of a lost opportunity to engage in the best alternative activity using the same resource. So that's broken down just a little bit. So I've talked about, does gravity exist? You dropped your pen. I put in here facetiously, well, what happens if you step out into the air on the 15th story of a building? I put splat. We know that gravity exists, right? Lost opportunities exist, costs exist too, and we can ignore them.
Right.
And for the most part, we do, but they're still going on out there. So we want to question, how does it impact our wealth building? All right, so here's what I want to do, Caleb. I redid this thinking, I kept working on this. How do you get this across simply? So here's what we're going to work through this case together. So what are the facts of the case? You have $100,000 per year that you can allocate to one financial option or another. That's our commitment, okay? The time frame for each financial option is 10 years. So we're going to do this, either whatever we decide to do for 10 years. No income or capital gains taxes are going to be considered here, just to keep it simple. That would add another element of difficulty. Right. A local investment banker is willing to pay you 5% interest for any cash on deposit.
Okay.
So we're going to use that 5% as our baseline lost opportunity cost, because we know we can get the 5%. Okay, so I built this case kind of as a no-brainer at this level.
Yes.
So what's our first option? We can purchase raw land from a seller on a 10-year contract for $92,000 per year. Okay. The developer signs an agreement to purchase the property in 10 years for $1,564,000. Now, in reality, would this really happen? Probably not, but it could.
Okay.
In a reality, the business person looking at this may say, I think in 10 years, I'm going to be able to sign a contract for $1.5 million.
Right.
But I wanted to build assurance in here, saying
sure.
This is a slam dunk. We know we put in 92 a year, we're going to be paid 1.5.
Yes.
All right. Expenses, property taxes, insurance, legal and accounting fees add up to $8,000 a year.
Okay.
So when you sell the property in 10 years, the annual growth rate on your $92,000 investment per year was 9.47.
Yes.
That all makes sense.
All makes sense.
Okay. However, we had $80,000 of costs.
Correct.
that we had to pay. So that brings our final profit, so to speak, at 1.4 million.
Yes.
All right. So that's over the 10 years. So now if we take that number and divide it, in other words, our total cost to get the outcome, it drops our effective rate of return on the investment project down to 0.7%.
Got it.
So at this point, we're feeling, okay, we've got a pretty good handle on this, right?
Mm-hmm.
We know what we're up against. Now, here's the second financial option. We invest $100,000 per year in government bonds, which pay 7%. At the end of year 10, your bonds mature for a total value of 1.478. There are no expenses. Now, at face value, which option would you take? Investment option 1 or 2?
Well, I would take option number 2 because the bonds are a lot safer.
Okay, so you're incorporating risk.
But yeah. But option 2 also looks like it has more money too.
It does. So let's say that the person that signed the contract to buy that development land
It's guaranteed.
was a Fortune 500 company.
Okay.
And it's in contract.
Okay.
So if I eliminated your risk concern,
I still would choose option 2.
I understand.
Yes. Yeah.
We're coming from a different world.
Yes.
Okay. Given this information, which option would you select? Well, if you chose option number 1, you're not alone. That's the one that most people would look at. Okay. Now, we haven't done anything from an analysis of given up lost opportunity costs. So on the surface, option 1 yielded $6,100 more because we earned 7.07 instead of 7.
I understand.
We're tracking there, and I think everybody can. Now, remember, the rate we utilized for our lost opportunity cost was what we know the investment banker would give us.
Mm-hmm.
Okay? So that's what we're going to use as our, remember Schmody said, our other alternative?
Yes.
Okay? Now, what's interesting is I'm going to throw this in. If you talk to somebody who says, well, I can get 12% rate of return on my stocks, and you use a 12% rate of return as your lost opportunity cost, because that's what they think they can earn, it drives up the lost opportunity cost expenses. Okay. So if you invested that $8,000 per year instead of paying the additional expenses of option number 1, you could have again earned 5% on that money. Paid annually, this compounds over 8 years to a total lost opportunity cost of $105,000. All right? That was your cost for number 1. So if we take the $105,000 minus our cost, because the true cost of $8,000 we've already allocated for, we haven't added the cost of the true cost, which is $25,634, what we could have earned on the lost cost. Now we take those two on investment option number 1. See where I take the $25,000? Yep. What is our total wealth gain on option 1 compared to option 2? Well, first of all, we subtract the true costs, then the opportunity on those true costs. Our true rate of return on the project dropped to 6.77%. Remember, we were talking about 7.07? Yeah. Now, let's look at the two side by side.
So, playing devil's advocate with you, the financial scenario 1, after 10 years, you're actually not getting the 1,458,915. You're getting $25,000 more than that, right?
But you gave up an opportunity with the investment banker that took away from your total wealth building.
Whereas over here, you have the opportunity.
There was no cost, so there was no compounding on the cost.
But you didn't have, in scenario 2, you tied up all your money in the bonds.
And in scenario 1, you tied it up in the raw land.
Right.
And there was no cost on the bonds, so therefore I gave up no lost opportunity cost on any cost to obtain it.
I will continue to go for this. I just feel like I don't necessarily track what you're saying here, because it feels like that 25,634 is added, but it doesn't seem that practical, because I feel like when you're adding the $80,000 of cost, it's a true apples to apples comparison from a cash flow standpoint, isn't it? If you go back to
100,000 committed to the project.
Yeah, versus 100,000.
Each one was a $100,000 commitment.
Yeah. So you could just say that you're almost penalizing somebody with opportunity cost, because the cash flows are exactly the same, or are they not? Is financial scenario 1, are there more cash out of pocket than scenario 2? Same cash out of pocket.
100,000 a year.
Let's move, because I don't want to derail this. I just I don't know if I agree with the 5% loss opportunity cost in this scenario, because I'm just trying to figure out, yes, there's loss opportunity cost, but what's the end result?
In total wealth building.
Let me ask you this. What scenario would you do, option 1 or option 2, if option 1 was guaranteed? You could earn a 7.07 or 7%, which if you were given option 1 or option 2 with guarantees built in, which one would you choose?
Am I getting to choose whether I apply lost opportunity cost?
Well, this is a real life scenario. I give you option 1 or option 2, and of course you should apply everything.
Then option 2 is going to give me more wealth building at the end of the 10 years.
How?
That's exactly what it gave me in wealth building.
So I chose option 2 because I factored in
For
risk. But I actually would go back and choose option 1 unless I'm clearly missing something that you're seeing. But if the cash flows are exactly the same, why wouldn't I take a 7.07 versus a 7%?
Okay, let's take our focus off rate of return. Let's start there.
Yeah, but the whole purpose of investing in option 1 or option 2 is rate of return, I believe.
It could be, or it could be which one at the end of the day has given me the most wealth building.
Okay, but then
which is a function.
Help me understand how you're getting more wealth building in option number 2.
Over here, there was a hidden cost by you having to pay that $8,000 a year when it could have been earning something for you at the bank.
Right, but at the end of 10 years, don't I have the same cash flows as
this in your wealth building, not in what's in the bank? But if you looked at your economic model, you gave up this $25,000 in your model. It's something that you could have earned, but you didn't get it. So in your economic world, you would end up with more money with option 2. And I want to stress this because we may not get to it.
Yeah.
This is the hardest concept you get your arms around.
Yeah, I hear you, and most things I can understand, and I just don't. I almost want to draw this out because I totally understand if there's a different cash flow. Is it because you're paying over time with the 8,000 every year? Whereas can we go back to scenario number 2? Just go back to scenario number 2. So scenario number 2, you invest $100,000 per year. Okay, can we go to scenario number 1? Isn't it fair to say that I could just hear me out here? I could just say this is including $100,000 every single year, and I'm earning a 7.07% rate of return every single year.
Your effective rate of return by getting the $1.4 million back was 7.07% on the total outlay.
And we can agree that $100,000 is going out of my pocket every single year.
Yep.
Now, what I'm trying to say is it doesn't matter if it's split up into 10 different buckets, $100,000 is going out of my pocket. Now, next scenario, same person, $100,000 is now I'm earning 7% instead of 7.07. Mm-hmm. You're trying to tell me that when you add in this loss opportunity cost calculation, that you'd be better in scenario 2 when you're earning 7% versus 7.07. I feel like that's the definition of gaslighting right now. I'm just being real with you because I'm just I do not agree with that, especially since the cash flows are exactly the same.
This is the page where, to me, it starts. Are those 80,000 costs, or are they going into the raw land?
It doesn't matter because I'm outlaying $100,000 for an outcome. That's for me, and how I don't care if it was in this scenario $10,000 going into costs and the land was 90, because it's costing me $100,000 to get the output, and that's why 9.47% is not an accurate number. We can both agree on that.
Absolutely.
It's not accurate.
Everybody gets that.
Because you're not factoring in $8,000 a year. But if you go to the next slide, the 7.07% is an accurate number because you're factoring in the full outlay of cash flow.
But we're still missing one calculation.
Loss opportunity cost.
What the 80,000 could have earned for you if you didn't have to spend it on these costs. That's where it starts fundamentally.
I know, but can we agree that if you didn't pay the 8,000, you wouldn't have the land opportunity? Like the 8,000's bundled in. It's not
the
like
cost of the project.
It's not like where I could get behind what you're saying is if the 8,000 was voluntary, but it's the cost of the project.
Sure it is.
So why can't we just bundle that in? Like that for me, it's like when I think of lost opportunity cost, I think of something that is not essential to, like if the $8,000 was one of those, like, this is what we're spending to going to the land and enjoying it or something, what's not essential to the investment, I can totally get behind this lost opportunity cost. But it's essential to the investment, and that's why I don't think that this, I'm sorry for being difficult. This is where like and we'll continue to move on.
I struggle with it too, Caleb.
But I actually like, this is where I'm not academic at all. I honestly think that you would be foolish to take scenario number 2, because scenario number 1 would result in more money, assuming that the only outcome we care about is rate of return. Because
I would agree with you there.
Okay.
If all you're concerned about is rate of return.
But so lost opportunity cost in this scenario, it doesn't do anything for me.
But rate of return on what?
Rate of return on your $100,000 outlay for the last 10 years.
Okay, but I can get also, in addition to that, some rate of return on that $8,000 if I didn't have to spend it on.
But the $8,000 has to be included with the $92,000. Or
absolutely, it does. Because
okay,
it's that project.
I know let's move on.
Yeah,
I think
you're getting a lot of editing to do.
No, we're keeping it all in. Okay, we're keeping it all in.
Let's go back though to something that you said, and maybe this is a good fundamental starting point.
Okay.
You said and I'm not going to be able to repeat your words, but it was something, a little bit of this fact that, well, here's a perfect example. Mm-hmm. If I buy a latte for $7, there's a lost opportunity.
Correct.
Cost.
I get behind that. It's not just what the latte costs, but it's what's that $7 could have earned you the rest of your life at that 5% rate of return, if that's what we're going to use.
Okay.
Yeah.
Let's start there.
Okay.
This may be helpful. I do not define that latte as a lost opportunity cost.
Okay.
And I wish I would have gone back to some of my writings, but let me describe it. You have given an opportunity to contribute to your wealth building. That's all it is. You chose the latte over wealth building. So is there an opportunity lost there? Yes, there is. But let's now define what true lost opportunity costs are based on.
Okay.
This is where the LEAP model, I think, is helpful.
Okay.
So on the left of the LEAP model, I call that lifestyle. Do we all have lifestyle?
Yes.
Yes. Food, clothes, groceries, travel, entertainment, magazines, cable. Yep. We all understand those things, right?
Yes.
That's not going to go away.
Yeah, but you can choose what type of lifestyle you have.
I understand.
Yeah.
But let's say that this is what it is right here.
Okay.
Now, let's say that you commit, I used this term earlier, in my 35-year-old commits 15% of his income to wealth building. So we're putting the latte decision aside.
Okay. You're pretty much spending 85% on consumption, 15%. Okay.
Okay. And this, I think, is important because this is true lost opportunity costs, not lost opportunities. So now we've committed that $15 to wealth building.
15%, yeah.
Or 15%, thank you. Is it now a part of lifestyle?
No.
Now it's in my economic model. Now I have to look at options in my economic model, and here's where we start looking at the cost of the lost opportunity cost of decisions. And if it's ignored, it will impact your wealth building capability. And maybe that's all I can say at this point.
Okay. Let's okay. Yeah.
We don't want to confuse it with the latte decision.
Yeah. No, I totally, I don't want you to think I don't understand lost opportunity costs. We might have different ways of thinking about it, but if I make a decision to invest over here, I'm unable to say yes to a million other things. There's a cost to that. Now, it would be impossible even with AI to factor in all of that if you're factoring in a million different potentials. So usually when it comes to a model, you have to put some type of rate of return as an opportunity cost thing.
Yes.
But even like Todd Langford has maximum potential. I'm pretty sure Leap has something like that. Whereas you look at every dollar that you made was compounded for the rest of your life. I mean, people would be worth $50, $100 million kind of deal. But the reality is that's not true. But then when you look at when you pay taxes, when you do certain things, it's not just that, but it's now what that costs you over your lifetime. I put that in the category of opportunity cost. The only reason we can say that is if you factor in some type of rate of return to that. Let's move on due to time, unless there's another point. Like, I will just accept I hear what you're saying, and I think it's important for people to understand that I'm not here, like, I want to learn as well, and I'm a verbal learner, as some people very much dislike, and they tell me all the time in comments.
Okay, Don Blanton, I think, does a good job of explaining those opportunity costs, and I gave you 25,000 of them here. Whether we accept it or not,
okay,
I gave you 25,000 of lost opportunity costs. You're either going to pay for that out of wealth building, or you're going to have to go back and dip into lifestyle to pay that cost.
Mm-hmm.
And that's something that probably Circle of Wealth does better. Now, I also am going to say this.
Okay.
Until you get your arms around this concept, some of what I say is
you're gonna, I understand.
I understand. Hogwash.
I feel like I've already failed this section, but let's continue to move on.
That's
fair
enough.
It's a good thing I'm not in college and you're not my professor. Right?
Yeah, I can tell you that it drives me nuts too, and that's probably why I also don't focus my energies here.
Yeah, I understand.
Trying to help clients. Now, you see what your total rate of return was when you figure in the cost of lost opportunity cost on the $8,000. It brought your effective return down to 6.77. Anyway.
Yeah, we'll move on. I don't know if I agree with that analysis, but you got letter alphabet soup behind you. I've got nothing.
Well, that's not where this comes from.
I know, but
it's studying it after I was introduced to it with Leap. I mean, I never heard of it before until I was introduced to Leap.
Okay.
Financial planning community doesn't give it to you. So we're going to start to build on this a little bit. Well, what if, okay, you say, well, 25,000, oh, well, in the big scheme of things.
It matters, though.
It matters. So what if you made that mistake 10 times over your lifetime? 194,000.
Right.
All right. If that same lost opportunity cost, that extra 19 was left in the bank for 20 more years, it would have accumulated to 51,000. So once a opportunity is taken out of your wealth from a cost, a hidden cost, you're not going to get it back. Right. So we're going to look at a couple of quotes here. So this gets back to me. Are you chasing rates of return without considering lost opportunity costs? Okay, now I threw this in because I remember we started this with this female who could purchase, I think it was a female, for $188 a year term insurance.
Yeah, super cheap.
What's interesting was whenever you go down this path and you start seeing it, they always talk about a super preferred.
Yeah, I love that.
It's like, why? Because you can show the absolute lowest premium. And what I've got here statistically, only 4% of the population fits in that category. That's wild. So why are you even beginning there as a baseline?
I will say when we run analysis, we're starting to use standard across the board. Good. Because it's just middle of the road. It's standard for a reason. And so that's
right.
It's and even you could even say based on this, standard's pretty middle of the road. So
and for a standpoint of the consumer, if I come in above standard,
now you're happy.
You're happy.
Yes.
If I give you super preferred and you come any one of those others, you're disappointed.
It's
yeah. So position it correctly. Okay, what are the three projects?
The day before retirement, the day after retirement, the day after death.
Yeah. Okay. So now let's get into, this is the part I inserted for you.
Okay. I've already failed step one, so we'll see. It's not going to go well for me.
I want to tell you, it's the hardest thing to get your arms around. All right. So here, again, Caleb, these are the ones that I put together for you.
Okay. Can't wait.
This is custom designed for Caleb. So we have three scenarios, and here's the fact of the case. We're only going to look at a 5-year project because we've got somebody at 65 that's doing something. So we purchase $1 million of bonds at 5% interest. They get $50,000 a year and they die at age 70. So how much income did they have? $250,000 of income. How much did they leave to the children?
$1 million.
$1 million.
Got it.
All right. Number 2, I gift $1 million to a charitable remainder unit trust. The effective payout rate is a 7% annual lifetime income.
Okay.
So that means I get $70,000 a year. And after 5 years, I've received $350,000 of income. How much goes to the family?
0.
0. We've done no joint lives.
Yeah.
We don't have a replacement trust.
Okay.
You get the idea.
Yep.
All right. Next 2 options. We buy $100,000 in CDs, paying 3% interest. We let the $3,000 of interest accumulate. So at the end of the 5 years, we pass on $115,000 to the family.
Okay.
We buy $100,000 speculative development. It goes belly up in 4 years and 11 months. How much does the family get? 0. Back when I was 30, I purchased $500,000 of 30-year term. My premium was $188 a year. So over 30 years, I paid $5,640.
Mm-hmm.
How much death benefit did my family get?
0.
Because
You outlived it.
I outlived it. Number 2, I purchased $500,000 whole life at age 30. I paid $4,015 a year in premium. So I've now put in $160,000 in premium. From 65 to 70, now we're entering this project. I had to pay another $40,150 of premium, right? Because I'm still paying the $4,015.
Okay. Yep.
So there's an outlay for me.
Mm-hmm.
How much does the family get?
500,000.
Disregard paid up additions.
Yes.
Okay,
Yep.
We're keeping it simple. The base policy. Is there a lost opportunity between choice 1 and 2? What did 2 get and 1 didn't?
Well, two got a death benefit, but you also have to factor in the difference in cash flow outlay.
Absolutely. All I'm focusing on is one thing here.
Yeah.
What the family got.
Right.
Okay.
The family in scenario 2 in this scenario got $500,000, and yeah, that's
That's
based
it.
on yeah.
Okay. I've tried to work you to a certain point here.
Okay.
So this is where you're going to get tons of comments.
Okay.
Okay. Now, I'm going to start with a high loss of opportunity rate because this is what Brian and Bose claim that you can get on investments.
Yep.
So we're going to use their expected rate of return. I don't believe, me personally, I don't think it's fair. Let's go back to the investment banker, say what's reasonable?
Right.
What could I get overall over a long period of time? But we know that the $188 per year for 30 years cost us $5,640, right? We had to pay that.
Right.
Have we gotten it back?
No.
Could, based on Brian and Bo's return assumption, we assume we could have earned 8% on that money instead of paying premiums.
Yes.
We're trying to look at the total cost here.
Yes.
So that means over just the 30-year time period, I gave up $23,000 of interest earnings.
I'm with that. So the term,
yeah.
easy so far. They paid. You're just looking at the term right now.
Mm-hmm.
They paid $5,640. That's all. Assuming 8%, the additional the $5,640, if that was invested in an account that they could earn 8% in, it would get $23,000. So right now we're up to $28,641.
It was taken out of their wealth.
Yes, and then what you're saying is assuming the $23,001 earning interest from age 60 to 90, that number would be $231,461. So if we just had to say from just the premium alone,
yes,
the loss opportunity cost at age 90 is over $230,000. I'm tracking that completely.
Yeah.
Now you're going to get in the place where you're going to lose me, but
Yeah.
I'm tracking through 0.3.
Well, I've got an asterisk by the next one.
Yes.
Lost death benefit.
Yes.
There is no death benefit paid.
Correct.
Because remember why I want to go back and define the life of the project.
Yep.
This project test is the day after death.
Mm-hmm.
So we know the $500,000 death benefit is not being paid through a death claim with the insurance company. It
Yes.
doesn't exist anymore.
Yep.
So from that vantage point, our total cost, well, let me back up a minute. Could that $500,000 death benefit be turned into income for the surviving husband?
Yes.
I lost something then by not having it.
Yeah, but going back to your life insurance 101, you're paying a cost for that, and it's only in that scenario, what was it, $188
$88 a year
versus whole life of $4,000.
Yeah.
So I feel like if we're going to factor this in, we also have to factor in the flip side of them investing the difference at 8%.
Oh, absolutely. When you start to analyze these, now you have to take both of them
Okay.
side by side. My intention here is not to do that. In a full analysis, you would,
Yeah.
because you're going to give up something with the whole
Okay.
life.
Is it fair to say if we're going to factor in the death benefit in this scenario and we're not using velocity of money, we're not using anything else, the buy term and invest the difference smokes this scenario by almost $4 million bucks. Did I do something wrong here?
When you're looking now, now we're getting down where we're going to have to start looking at all kinds of other things, because that's a pure gross rate of return
Right. Well, aren't you? Isn't that what we're doing here?
with these numbers right here.
Yeah.
Yep.
So I'm just like, and again, I think we would all agree that there's some, like, for example, the term insurance, 188. We just pointed out that that's a super preferred female.
Yeah.
So that's that.
Probably
We're
not
also assuming 8%. But what I'm saying is, I'm just saying, like, if I just had to look apples to apples, yes, I'm totally good factoring in the lost death benefit. But when you factor in on the flip side, this perfectly lays out self-insurance, because you have way more money to self-insure than a $500,000 death benefit. Now, what we're not including is the velocity of money and all in the other scenario.
And if we're starting to get back to an analysis of what you just talked about, more money to produce income.
Yeah.
We're starting to confuse it so much, because that number, that million, is assuming you're not taking any income off it. And I'm not taking any income
Right.
off this either.
Right.
The point here is we have to look at the true cost of that term insurance in the macro world, what it ended up costing me. Caleb, I am not taking this into where now we start looking at the whole life
Right.
and running a side-by-side
So,
comparison. I'm just not taking it there.
I totally understand. I actually don't disagree with your point here. I just think if you put the apples to apples comparison using the $188 per year for I actually think it's more of a commercial, especially at 8%. For when you include a loss opportunity cost, it's more of a commercial buy term and invest the difference in this scenario. I could be wrong on this.
Because we're looking at one factor that all we're trying to do is drive home the true cost of the term insurance.
I see.
I would rather stay away from it.
Okay.
We would get into a whole other subject.
Okay.
Now let's start modeling both side by side.
Yeah. Maybe we do a part 2 virtually on that, because I'm with you on this. I'm totally fine adding loss death benefit if you compare apples to apples.
Okay. So just over, now this cost is spread out over from age 30 to 90.
Mm-hmm.
But I wanted to break it down just to make a point. If we're paying for that term insurance over 30 years, and we know the total opportunity that was lost, so I'm going to break the total cost over a 30-year period. The total cost of that term insurance was $24,000 a year, not $188.
Right.
Okay.
When I saw this case study and I was looking, I was like, but that's okay, because realize, as we showed in the best case scenario for the infinite banking, the death benefit would be $896 and the cash value would be $532.
Mm-hmm.
You don't get to keep both.
No.
Now, but let's bring it down to something more practical.
Mhm.
The only reason I would use an 8% is because Brian and Bo are claiming that you could get an 8%.
8%.
So I like to go back and say, let's just, maybe this is philosophical.
Mhm.
I would tell people, let's just assume you can get a 4, 5, or 6% rate of return on all your money over your life.
Yeah.
And if that's good,
I think that's,
and if we can do that and get the same or better results
yep.
and take less risk on investing, let's use that then as our.
I agree with that, where it's in your models assume worse rates of return, and then if you get better rates of return, everything gets better. But if you assume high rates of return and then it underperforms, it's like it's the definition of under promise over deliver kind of deal.
So what I did is broke down that lost opportunity cost here to the 5%, a lower. Well, it dramatically drops these top three, but we still have lost the death benefit. So the cost, not premium, the cost of the term insurance over 30 years was $19,000 of total wealth over the lifetime.
I see.
Okay. So $188 per year premium versus economic cost of $19,000 a year. So this is why I want to drive home, and everyone should be very careful in their mind when they hear these terms, premium and cost, thrown out there.
Yeah.
You very clearly in your mind have to determine what are they talking about, because they're not the same. Premium is simply the dollar amount to pay for the coverage.
Yep.
It isn't looking at how it's impacting your total economic model over a lifetime.
Yeah. I'm with you on that. It's sometimes easy to look at the price of something, but you have to factor in whole scenario of like, what did it actually cost you? Another example could be you put your money into a black box and you earn 2%, but you could have put your money in something that earned 10% over 50 years. That it didn't technically cost you anything earning 2. You didn't have to write a bill,
Right.
but the cost of not being able to do the 10% was massive. It could be millions of dollars over your lifetime. And so that's another example of that.
Okay, I brought this back in. Now, this is whole life.
Okay.
That's not being, let's use the term overfunded.
Yes.
This is just a base premium.
Base premium.
So I ran a couple of illustrations. I think it's reasonable to assume that the actual total death benefit on the whole life at the death would be $600,000 to $700,000, not $500,000.
Okay.
So we're adding that layer of paid up additions, trying to keep them separate. So we keep that discussion about the level premium separate. Okay, now here's where, so you got to buy into this fact that there's lost opportunity costs. So now let's go back to a couple of people that we both respect in the industry.
Yes.
Now, Bob Castellone, I've pulled this quote from him a couple of times because he updated some numbers. So I don't remember when I did this, but let's look at what he has determined. Because he looks at adding up lost opportunity costs on all kinds of things, like automobile financing, just a variety of things.
Okay.
And he says, let's dig into this. I have calculated that a typical family will incur between $5 million and $10 million in lost opportunity cost in their lifetime. Therefore, it is important to identify these costs and learn how to minimize or avoid them in the future. If people would spend more time trying to hold on to their money instead of spending so much time trying to find an investment to make money, they would be much better off. Now, Bob was an econ major. So I have to trust Bob understands. He studied lost opportunity cost in college. I didn't. This is a part of Bob's brain. It's not a part of mine. Now, let's go to Don Blanton. You know Don Blanton.
Yes.
You respect him.
Yes.
They're a protege of Bob's,
Yes.
as well as others. There are only 2 ways to improve your present financial position. The first is to find better financial products that offer the potential to pay higher rates of return, but often require more risk. The second is to be more efficient by avoiding unnecessary losses. And what he's referring to is lost opportunity costs. So Caleb, in the video, Brian and Bo talk about you don't get to keep both. So in other words, they're talking about you don't get the cash value, you don't get the death benefit. So I want to talk about that a little bit. I'm going to say yes and no. because you know full well that you can be leveraging
Totally.
the assets of the insurance company and using your life insurance as collateral, right?
Yes.
Now, I don't think they quite understand that because they don't understand this whole infinite banking thing. But we know that's a way to be leveraging reserves in your favor. And at retirement, you can use the death benefit. This gets back to the 1X planning. You can use the death benefit as an asset replacement tool to replace your other assets, giving you full permission to spend them entirely and enjoy them while you're alive. And what does the life insurance do? It pops alive and it replaces the value of the assets at your death. So to simply say you get one or the other is maybe true, maybe not true.
I understand.
mean, you got to look at it from a bigger perspective. Next thing I want to talk about as we summarize this, and I'm going to read the definition. Here's what the definition of financial planning by the CFP board. Financial planning is a collaborative process that helps maximize a client's potential for meeting life goals through financial advice that integrates relevant elements of the client's personal and financial circumstances. Now, I have bolded,
Interesting.
maximize a client's potential. How can you maximize a client's potential if you ignore lost opportunity costs?
Well, and I don't know if they're really highlighting risk in that definition, because they're mentioning circumstances, but what do they mean by that? Is it just so? Yeah, but that is interesting. I 100% agree with that.
Okay, so here's something that I want to lay out, because we've talked about Bob Castellone, 5 to 10 million of lost opportunity costs. Term life insurance is a place where we experience lost opportunity costs. Investment and advisor fees, and you notice I put a sad face there.
Yes.
I mean, it's reality. Every fee we pay for an investment, there's a compounding impact
Yes.
of what that fee could have earned us if we didn't have to pay it.
Correct.
Now, I'm not going to say that investments with a fee is bad. I have them.
Mm-hmm.
I help clients with that because I believe investments serve a place too. But we have to acknowledge
Yes.
it's an opportunity cost and what it could have compounded to. Automobile financing, you're well aware of that. Auto insurance. If you can build a way to run higher deductibles
Yes.
and calculate the lost opportunity cost in the premium savings and taking some of your own small risk, this is another area
Yes.
that adds up significantly over a lifetime. Taxes and fees, credit cards, right? And you see, I put a sad face,
Yes.
financial planning fees.
You're going after the CFPs today.
Well, Caleb, I was being coached to be a fee-based only financial
Yes.
planner, and I walked away from it so discontent. I don't do fee-based planning. If I get to the point where CFP board is requiring me to fill out hours and hours of paperwork, the kind of work I do, I will have no choice but to charge a fee to fill out the paperwork they're requiring. But the fact of the matter is, it is a lost opportunity cost.
Cool.
And it compounds over a lifetime.
Cool. So in summary, lost opportunity costs, you gave a couple definitions, but I really like Don Blanton's
Yes.
simplicity of,
Yes.
and it just is saying there's really two approaches, and one is going after a potential greater return, and the other is not caring about the return but looking at the whole scenario. And the way that I see that is not just on your economic model. I know I'll go back to say it's looking at the 85% of consumption and saying, are you overpaying taxes? Because paying taxes
Yes.
is part of consumption.
Yes.
Are you being inefficient with your debt? That's part of
Yes.
consumption. Are you spending money on the things that you don't value? A lot of families are. They're buying things that they to impress people that they don't even like. My thought would be if you could come in and say, here's a tax strategy to help you pay less in taxes. Here's a better way to pay less in interest and debts. Here's a way to be more intentional on how you're spending. We're freeing up money that is gone forever.
Yes.
And that money is, you're not just freeing up 10,000, 15,000 potential, 20,000 potential, but now you're freeing up what that could have earned every single year. And so you're taking a $20,000 free up when you're in your 30s could be a result of $1 million over your lifetime just by the opportunity of it to grow. And so the thought process of opportunity cost, whether it's in your financial model or in your consumption model, is anytime you're losing a dollar, to quote Don Blanton, unknowingly and unnecessarily, there's actual cost to that. So maybe that's a simplified version of how I think of opportunity cost. You definitely are going to get our listeners thinking a lot. And I do think I will say we got to factor this in, and we have to be bringing this up to clients more, because you're totally right. If you're not even addressing this or measuring this, it can be, you could be doing someone a disservice.
Let me take your three fingers and define them just to help.
Yep.
2 of them that you gave us are a lifestyle choice.
Right. Yes.
So if you can eliminate those costs and dedicate them to wealth building, you have taken advantage of an opportunity.
Yes.
One you talked about, taxes, is a calculation once the money's been committed to wealth building. The taxes is an inefficiency on the right side of the model in my world.
Really? You would agree with that? Is paying taxes part of consumption? I would imagine so, because if you don't pay your taxes, you're going to jail.
Understand, but in my total wealth building,
Yeah.
in the financial moves I'm making, I'm using my right hand, and my left hand is lifestyle. The taxes need to be a consideration over here. Now, what's interesting, and we're going to go back to this with Don Blanton, I mentioned, is good at this. If you are not being as efficient on those tax decisions here, it's either going to come out of your opportunity over here, and it's going to pass over the fence, and you're going to have to pay for it out of lifestyle. So again, the point, 2 of the things you gave us are lifestyle issues.
That's right.
1 is a wealth building calculation.
And the common theme is lost opportunity cost does not discriminate. It will hit you anywhere and everywhere. There's an inefficiency.
Try to step out of the 15th floor of a building.
Yeah, I love it. All right. We're now going to be talking about black box financial planning. When you talked to me about this, I absolutely loved where your headspace is going. And I think this is going to be a really, really fun thing to look into. All right, Dan, the next thing that we're going to be talking about is what you call black box financial planning. And when we chatted, when you were walking through this, I was like, Dan, this has got to be a whole segment. Okay. Because I find this stuff really fascinating. And so without further ado, I'll let you take it from here.
Okay. So maybe just a little bit of background on this, and I alluded to it. I was being coached to be a fee-based only financial planner, and there was a very successful fee-based planner on the East Coast and one on the West Coast that were mentoring me. I delivered my last fee-based financial plan in Lander, Wyoming.
Okay.
And I spent the night there in a hotel. I was driving home back to the Front Range of Colorado, and I just was frustrated. I said, this is dumb. I am charging $2,400 for a fee-based plan. This goes back a number of years ago. And basically, I felt like what I was doing is charging a fee to put together a book. And so as I was driving home, I was thinking about this. What could happen today in this family's life? Well, certainly rate of returns could change. Interest rates could change. The whole economy could change. The husband could become disabled. The wife could become disabled. The wife could die. The husband could die. The child could become sick. The child might change plans about college. You see where I'm going with this?
Yep.
And we just spent weeks putting together this book on assumptions that may all be obsolete today and probably are obsolete. Yes. And I thought there's got to be something better than this because life is fluid. So I'm giving you that background. Now, I was trained and I was good at what I today call black box financial planning. And we're going to get into a little bit about why this is so standard in the industry. So I did this for years. Okay. And in financial planning software, it is primarily based on what I call black boxes today. So it's my way of kind of summarizing how I view the industry. Now, granted, if you get into cash flow based software, which I was using for fee-based planning, and we look at our standard platforms of the different companies that offer financial planning software, what's interesting is you've got to dig down and ask them, are we using black box planning, or are we using cash flow based? Some of them, no cash flow at all. Some of them only cash flow a big capability at retirement.
Yeah.
So let's set the stage. So what is black box financial planning? And this is very simply what it is. They look at every thing that you are doing or could implement as a separate box.
Yep.
So I've got a picture here, and this is basically how it goes. Okay, so on the left, we know how much money is in that box. So let's pretend it's the 401k. That's just one example. Okay, we know how much is in your box. Now, we've got to assume some rate of return on that money. So they pick a number. Now, guess what the software does? It applies whatever number you put in there every single year. It's a standard application of the rate of return. We all know that doesn't happen.
Never happens.
Okay. Now, it's easy then. You go to the other end of the box and you say, well, how big does your number have to be? Remember the Fidelity advertisement?
Totally.
And that's pretty much based on a withdrawal rate. Okay, full circle. Well, you need X number of dollars to withdraw 4% to live on the life. We have no idea what inflation's going to do, blah, 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 blah. But this is all made to be simple. Mm-hmm. So now we have only one more thing to determine. How much money do you need to be adding to that box every year to get to the size box you want? That's as simple as it gets. Mm-hmm. And guess what, Mr. or Mrs. Consumer? Guess what we have to offer you? This IRA, this 401k.
This financial widget.
You see where I'm going with this?
Yep.
Now, each box is isolated for its own thing. So let's brainstorm, what are some other boxes? Well, it could be, how much do I need in a box in the event of death? How much do I need if I want to put money away for college? How much money do I need to be setting aside in an account if I want to buy a second home in 15 years? Do you see where?
Yes.
Okay. Is any consideration being given to how these boxes might work together?
No.
Absolutely none.
Which is a big flaw.
Which is a big flaw of them. So now let's get back to this rate of return assumption for just a minute. And you know that I love to use Dave Ramsey for teaching examples. So in his 2004 audio CDs as a part of Financial Peace University, here's basically what he shares. If you put $50 every month from age 20 to 70, you get $1.9 million every time. And I guarantee you that if you put it in a calculator,
you're going to get that
1 million times, you're going to get $1.9 million. What does that prove?
Proves that math is math.
Math is math, and your calculator must still be working.
Yes.
That's all that it proves.
And just for the person at home, like, the reason that's such a crazy statement is you're almost assuming you're going to get that rate of return. Like, the rate of return is almost an afterthought, whereas like the only thing that matters is, are you able to get that rate of return every single year? Like, that's a big assumption. And
if you backtrack this math, guess what rate of return?
12%.
12%.
That's insane.
Everything that you follow with his, if you backtrack it, it's an assumed 12% rate of return every single year. Now, there's only one other thing I want to point out on this because you've got to catch it. Do you notice the time frame he used? From age 20 to 70.
Yeah, that's a long range.
He's leveraging the length of a compound interest curve, but yet at the same time, he never teaches how to stay on a longer compound interest curve.
Okay.
And we're going to get into that.
I love it.
Fair enough?
Yes, fair enough.
All right, so that's how I am facetiously going to describe black box financial planning. Now, why do I bring this up? I bring it up because I want you to start recognizing it as we listen to Brian and Bo evaluate things, because that is the way their mind is operating. And at least it appears for me, and I recognize it for what I believe it is. So they're quick to basically say, well, I could get this rate of return over in this box. Now, again, all they're doing is picking up dollars and moving them from one box to another. And again, we're missing the point. What is infinite banking about? What is 1X planning about? What is retirement income planning about? We're talking about a coordinated and integrated approach using various tools. You cannot stop at looking at one box compared to another.
Yes.
Fair enough?
Yes.
So what I would like to do is take a break right now in our world of recording. And this would be a place where we would play one of Brian and Bo's statements, okay?
Why don't you send us some policy design so we can actually do a side-by-side case study to see if this is merited? But
so in the clip that you just heard, Brian and Bo basically said, so we can now do a side-by-side case study to see if this is merited. You see how their mind is thinking? Instead of putting money into the insurance that they're trying to evaluate, they're going to now put it into some other box. So I think we need to recognize what's going on mentally with their approach. Now, I've stressed this before, but typically when this is our way of analyzing things, what is the general focus? It goes back to rates of return, because the emphasis has to be on getting a higher rate of return because we want the box to get bigger.
Yes.
And remember what I've talked about? That should be a secondary objective. Our first objective should be seeking efficiencies. And the way we're going to seek efficiencies is to start working with these boxes put together.
And another way to say that is the only thing that really matters is efficiency, and rate of return is a factor that you need to factor into efficiency. Is that fair?
Sure.
So rate of return matters.
Sure,
but
it does.
The outcome and result should be far greater than a net worth statement or rate of return.
Yep.
Yeah, got it.
Okay, so I put together an icon, which you saw on that screen, of what a black box looks like.
Mm-hmm.
This is my way of describing to people, you need to start looking at your finances three-dimensionally. Now, when you look at something three-dimensionally, you're walking around it, right? You're looking at how these boxes are tied together. You're looking inside of things. And you'll notice on this, we're looking at that the three-dimensional approach over what? Time.
Yep.
Okay, so that's a different way of having to do finances or look at finances. Now, I haven't brought this up yet, but I've got it on this screen. Do you notice what it says here? This takes inductive reasoning. When you look at black box financial planning, it uses deductive reasoning. Now, which one is easier?
Deductive.
Deductive reasoning is easier. So you got to put your head into this and work on it. So this ties into some of the things I want to comment on about the financial industry in general.
Love it.
Okay.
Whenever I hear the word guarantee, when you're talking about financial products, that's a heavy burden. That's a word, like I know when you're doing securities training, they tell you never, ever, ever use the word guarantee, because that's something that, I mean, if you are taking on risk, you that by its sheer nature is not, it's you're getting risk. You're taking a risk to reach a premium in return. There's a risk reward from that. A guarantee has to be at a lower price point, and that's why there's fees. There's lots of other things that I completely get why a guarantee is going to be a much lower rate of return.
All right, another clip that you just listened to, Brian basically gets into this discussion about offering guarantees. And I think what's interesting is this, I'm going to describe it as it's foreign to him. Now, you and I understand, Caleb, because we also are immersed in the insurance world. Guarantees are something that we understand and appreciate all the time, every day, right? It's just part of the insurance industry offers guarantees. Now, Brian makes a good point that if you accept guarantees, you're probably going to assume a lower rate of return. I get that.
Yeah.
But the reality is we also have to acknowledge, and we saw that through the articles that we researched, you can get better, more efficient results when you're incorporating products that offer guarantees. So what's wrong with that? Again, when you're operating in an investment silo, you're going to simply chase rates of return. If you're open to both silos, you can see the benefit of both.
Yes.
So I wanted to make that point out as well. Now, here's another clip.
Maybe the numbers will be compelling. Maybe when we look at an actual policy that's actually been designed for this strategy, maybe then it's going to click. Maybe then we're going to say, aha.
So Brian and Bo have said that, maybe the numbers will be compelling. They're not going to be compelling because what are they doing? They're comparing one box to another. And I'm still going to go back to, I don't think they really even understand what the whole concept of infinite banking is all about. And we're going to be spending some time on that. So it really serves no purpose at this point to listen to their evaluation because they don't even understand what's going on with the infinite banking concept. Fair enough?
Fair enough.
Okay. So I just wanted to summarize, and this is maybe part of why I call it black box financial planning. And it's something that I have grown in appreciation for over time. Remember I talked about who's customer number one. This kind of falls in line with this. Financial institutions are for profit. And you and I know and appreciate and do business with mutual carriers. The reality is they still have to have profit too, right?
Mm-hmm.
If they weren't making a profit, we would be concerned.
Yes.
The difference is they can share some of that profit that they're not reinvesting in the form of dividends, right? So how are they going to make a profit? They want and need our money. Now, this is straight out of the LEAP book, all right? This is what we're taught in LEAP. And I'm going to say they will acquire it in the quickest way possible. Now, going back to deductive and inductive reasoning, if I can get your buck through deductive reasoning, why on earth would I spend the time to force you through inductive reasoning? Who's
really
number one? It's not the customer. It's the financial institution, okay? Now, the regulatory institutions have fallen in line using things like modern portfolio theory for regulating the industry with little room for operating outside that box. I just printed off, and I want to share it with you. There's a PhD in math that basically says you can throw out all the math when it comes to investing. I have to laugh because we're regulated because of this stuff. And the reality is, in truth, it may be nothing more than facetious. Now, it's a part of the industry we live in. The financial industry developed a way to get your money in the quickest way possible by building a structure around needs-based planning. So remember the boxes. Remember I said I did this? I was taught to work on the 2-interview process. I would go introduce myself. I would gather information. I would come back with a recommendation. Staff put together most of the recommendations. I already knew when I was leaving the house what I was going to recommend. We needed to crunch a few numbers. And all I was doing is plugging in boxes where there was a gap. It was quick, down, easy, dirty. I mean, it made sense, right? And people doing it make a good living, and it will still continue to be part of our industry. But that's reality is, to a large degree, the industry is built on needs-based planning. Now, maybe more on the insurance side than it is the investment side. The investment side will use it for implementing more investments. The insurance side for what? Implementing more insurance tools. Black box financial planning relies on very fundamental human nature, greed. It's extremely easy to get people to seek a higher rate of return. Why?
Greed.
It comes naturally to us. Well, if my buddy can get it, I better get it too.
Yeah.
You see what I'm getting at? So it falls in line with how we're built as humans. We talked about deductive reasoning, which is easier. So why on earth would the industry want somebody to think deeper if you can get their money the easy way?
That's right.
All right. Math is used to prove points. And I know you appreciate this. Money has behavior to it. Math does not behave.
That's right. There's no emotion to math.
There's no emotion to math.
But there's an emotion to every human that walks the planet.
And what happens with their money.
Yes.
Because it's impacted by everybody else's emotions and environmental conditions and things. So when it comes to inductive reasoning, we want to start at the end and start looking at scenarios. Now, we've got to use math, but we want to use that math to say, let's look at potential outcomes to see which path we go down is going to give us a greater chance of success which is going to remove some risk, which is going to work in a variety of circumstances, not just one, if we get lucky with investment rate of return. Does that take work? Absolutely, it takes work. So you can observe this when you see how Brian and Bo evaluate the life insurance. To me, the black box planning approach is coming through loud and clear. So how would I summarize this? Seek efficiencies with every financial decision.
Yeah.
So
that's the idea is black box planning is looking at, this versus that. And it's almost like you're comparing this or that. Whereas the integrated planning is saying it's an and this thing and this thing and this thing. Going back to what we said earlier, life insurance, a SPIA, a reverse mortgage, an investment portfolio, that now you have 4 tools in a tool belt that potentially creates greater outcomes, greater cash flow, potentially greater legacy. And it's not like you're just saying, put all your money into a home and do a reverse mortgage.
No.
Or what you're not saying is put all your money into life insurance and nothing else. And what you're not saying is so it's like someone could say, well, does that make it right or wrong? It's like, no, just because you're not going to put all your money into whole life insurance doesn't make it a wrong product.
No.
That just and I think that's where we get so simplistic. And I see it on both sides, but you see it a lot in the investment side, whereas they almost go, because I wouldn't put all my money into an insurance policy, insurance is bad. Permanent insurance is bad. Buy term and invest a difference. And you go, hold on, like, what if insurance could be the bond portfolio and couldn't you get a better outcome? We've literally seen different articles break this down. Let's at least debate it. You can disagree with how they run, but let's debate that concept, because it's not a either or kind of deal. So I love it.
Enough.
Is there anything else you want to talk about?
No, I think that gives you a good feel for it.
Cool. All right, now we're going to talk about philosophy, science, Austrian economics, and infinite banking. Lot here. This could be a full episode in itself. But I very much look forward to hearing your thoughts around this, because we have been really technical. We've looked at loss opportunity costs. We've looked at really heavy academic research when it comes to retirement planning. We've looked at Life Insurance 101, which, talking about terminal reserves and all, like it can be very technical.
Yes.
And now we're going to get into philosophy, and most people start with philosophy and get technical. I like that we did it the exact opposite. We're like, hey, let's get super technical. Now let's zoom out, and without further ado, I'll hand it over to you.
Okay, with that introduction, Caleb, I think maybe what would be helpful is for me to also set the stage. Keep in mind that the first half of my career, I was captive with one company. So I was pretty well exposed to what I was exposed to through that company. I would say that Leap was the very first major exposure I had outside of that company. And I actually was exposed to Leap at a conference in 1995.
Wow.
And couldn't pursue it until I left that company. So when it comes to infinite banking, this is real late on my radar screen.
I see.
Okay, so of all the things we've been talking about, infinite banking is probably the latest. So by no means would I call myself an expert here, but I think I know enough about it and understand it and appreciate, because ironically, I have incorporated, I think as you can see, some of the concepts behind infinite banking for years, but not to the extreme where infinite banking focuses more energy there. So to set the stage, just so you know, and where the audience knows where I'm coming from. But why I thought it would make some sense to spend some time on this is I really don't think we can do an evaluation of Brian and Bo's The Money Guy show, an evaluation of their evaluation of infinite banking, unless we first step back and try to understand, well, what is infinite banking?
That's fair.
All right, because how on earth can you begin to analyze a product until you know how the product fits in to the overall strategy? And I think it's important to first step back and say, what is Austrian economics? Because the whole idea of IBC was birthed, so to speak, out of this idea of Austrian economics. And so what I would like to do is spend some time on that And I think if I were to summarize, there's two major concerns of people that come from the Austrian School of Economics. One is modern monetary policy, and the second is the control that the Federal Reserve Bank has over us. And once you understand the concern of those two things, it then begin to appreciate some of the things that infinite bankers are appreciative of. Fair enough?
Fair enough.
So what I've done here is I've put just some bullet points together as I see it, trying to look through Austrian economic eyes and then how that ultimately applies to IBC. The first is freedom. I don't think many people would deny we've lost freedoms in this country. I would be the first to say, I don't feel I have hardly any freedoms in the investment world. I am so highly regulated, it controls activity and efficiency. And I think people are sensing this all over. And an Austrian economic would say, what steps can I take as a person, as a human, as an individual household to gain freedom, right? The value of private property, we are losing that in America. If you think you own property, just wait until your property tax bill comes. And all they have to do to take you out of that house is to raise your property tax to the point you can't afford it.
Sure.
Now, I'm not saying that property tax is necessarily wrong. We have to yield to Caesar, right? But the flip side of it is we have lost ownership rights in this country. And there are people that live in gated communities. There are people that live in subdivisions with covenants. But I will tell you, every single one of them slowly erodes an individual's property rights. And if you ever want to think you have the right to do what you want with your own property, just go to the Housing and Development Office in Larimer County, Colorado, and Fort Collins and find out what right you have to build. Because they'll give you documents that are pages and pages and pages and pages thick. They control what you have the right to do with your land, okay? Now, the impact of central banking and the monetary policy. I can tell you, and I'm not going to get into details, 2 times in my wife's life and mine where decisions that were made by the Federal Reserve Board had a very negative impact on us personally. Now, did that help the overall economy? Maybe, but for a benefit for one person is always going to be harmful to another. And we are subject to what is going on now through that. And it is not a federal agency. It is a private corporation.
Yeah.
Okay? We have to have an understanding of scarcity versus abundance mentality. Now, if we listen to somebody like Tony Robbins, we all would, oh yeah, the sky's the limit. But the reality is, you and I only have so much coming into our economic world.
Mm-hmm.
We have to be efficient with it. There is a scarcity of money. There's a scarcity in every household's world, right? Unless you're one of 3 or 4 people probably in the United States. There is a scarcity. We have to recognize that. The fractional reserve system in banking, and this gets back to velocity of money. Banks could not operate today if it weren't for fractional reserve banking. Now, the reality is, I believe it has to be there if we're going to have banking.
Yep.
But on the other side of it is, we also have to understand what fractional reserve banking is and be able to incorporate it in our own economic world. And I think Austrian economics starts us down that path. The next one, and you address this one in your book, we finance everything that we purchase.
Yep.
Period. Because you are either paying for interest if you purchase it on debt, or you are giving up interest earnings because you paid cash.
Mm-hmm.
And this is something that is very fundamental to start getting your arms around. If you can come to grips with that, you finance everything you purchase, it would help you immensely to start taking you down this path of infinite banking. Now, you and I have talked about this. There are abuses everywhere in the industry.
Right.
There's also some of the highest caliber people I know are in our industry.
Mm-hmm.
But there are people that will also take this too far. And so we've got to be careful about, do you use your life insurance to buy groceries?
Right.
I'm going to give you an example.
Yeah.
Okay. Now, capital is scarce. And when there's a need for capital and opportunities arise, capital is king.
Yes.
Cash is king. And under Austrian economics, that is recognized. I would tell you that I think from a natural standpoint, if you are not going to leverage infinite banking, most households over a lifetime will have 2 or 3 opportunities that are literally plunked down in their lap. And if they do not have the cash ready to take advantage of them, they will forego them. And it could be one of the largest things that leapfrogs their wealth building.
Yeah, I appreciate you saying that. When I was actually in Colorado, this is bringing back good memories. When I was in Colorado, I listened to a podcast by somebody, and he made a lot of money, and he went against the grain. It had nothing to do with infinite banking, but it has to do with your statement. He said, my opinion would be, what you should do is put your money in a savings account. And he said, in your lifetime, there will be a few crazy opportunities that could change your life. Go all in on those and have the capital to be able to say yes to that. That was his philosophy. He's not maybe saying everyone should do that. He's just saying, that's how I've grown my money. I've not tried to lock up my money and try to get market returns. I've tried to look at the opportunities that were going to be next level. You mentioned a good point, because a lot of times, including myself, when we look at infinite banking and we compare life insurance, we're not comparing any of the massive upside. We're usually comparing, we're trying to keep it level, because rightfully so, it could be very misleading. But you're totally right. If you believe that there's going to be a few instances in your life, and you believe this concept of the golden rule, those who have the goals make the rules, you would want to put your money somewhere where you could have easy access. Now, someone could say, well, yeah, you have money in Robinhood and you have money in indexes and other things. Usually when a lifetime opportunity comes is when there's, as Warren Buffett would say, blood on the street. Usually that would mean if your money is in the investments or in Bitcoin or in other things, usually that opportunity that's going to be life-changing doesn't always correlate with your investments or Bitcoin being at the highest. It could be that there's an amazing opportunity when it's super low. And so I think that's the pushback when someone says, well, you could do this anywhere. Yes and no. I think the best scenario is to compare it to either coffee can or a savings account. Because those are, even though a savings account, fractional reserve, could the banks fail? Sure, but I don't necessarily get into that. I think a savings account is the best way to compare this idea of like where you're going to store your money to be able to say heck yes to something. I don't want to derail too much. I just wanted to. I appreciate you mentioning that, because that's something I don't mention enough, and it's part of my philosophy. That's why I have so much liquidity right now into life insurance, is because of that belief. It's not just because I'm going to keep my money there for the next 40 years not doing anything. It's because I really do believe that there's going to be opportunities that I'm going to be able to say yes that will be life-changing for our family.
Yeah, the money guy gets into two things. Again, comparing it to a bank account. And what if you have to pay that surrender fee on a universal life? We're not talking about universal life. We're talking about whole life. But again, this isn't a short-term approach. This is a long-term view of this is the long game. And the other thing is, we consider the gentleman you referred to on the podcast. We have to go back to what asset gives us the better capability of housing that liquid money. And I'm going to go back. Remember, I mentioned Don Blanton's book on where he spells out the characteristics you want in a tool to collateralize.
Yep.
And at the end of the day, life insurance by far comes out ahead.
I agree.
Okay. Capital is scarce, just like, liquidity is scarce.
Yeah, I think we left off our ability to take advantage of opportunities when we have access. Yeah.
Okay. Life insurance companies are a major source of capital in the United States. I mean, it's just reality. And we have to look at, the history of life insurance companies. Who was buying land in the Midwest in the Depression? It was life insurance companies. They had capital. Now, I am going to throw this caveat in. We are in a new world today. because we now have a life insurance company that's owned by a venture capital group. So I think we also have to acknowledge the times are a-changing. And I don't know that we can count on the life insurance industry if we have historically. But would be another reason to basically step back and to say, looking at least at the mutual carriers has validity.
Right.
Because they're not driven simply by profit margin.
I see.
Okay?
If you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods.
All right. So the next thing I wanted to do, Caleb, is let's talk about some different ways that we could use infinite banking. And let's do this right away. And then I'd like to come back and tie it in to some things in your book. All right. So financing the purchase of a short sale. So back in the housing crisis of 2008, there was lots of houses that were being sold on short sales. So let's say that your neighbor was talking to you across the fence and they were in trouble. You could offer them cash, right? And you could say, if you were in a position to say, I'm probably going to have to sit on this a while. I mean, it might be 5 years before the market turns around. But you do some work on it and you say, I think, in 5 years I can sell it for this. And I know I've got to put $20,000 into it to fix it up, blah, blah, blah. But I'm going to have some rental. I got to figure out rental vacancy, that kind of thing. But this would be an example of an opportunity where you can turn something. It's like flipping a house over a longer period of time, right? Mm-hmm. So cash is king here. Purchasing a business for cash flow. I hear a lot of this out of the IBC community. Build a business for cash flow, right? It's a reserve that you can have access to. On whose parameters?
On yours.
On your parameters. Real estate bridge loan. I want to mention this. I have clients that moved from Colorado to Texas, and they did this. And they didn't have to answer to anybody. We took out life insurance loans. They went down and made an offer on the house in Texas, and they got the house they wanted. Guess what they could say? We're paying cash.
Yes. And then they could refinance after if they wanted.
Absolutely. And they don't have to worry about the sale of their house. They could get it on their time and be patient with the market. And when there's concerns that come up and we start talking about the loan, do we need to be overly concerned about that? If you pay the interest on the loan every year, it's not going to impact.
Right. There's a lot more flexibility.
A lot more flexibility. So those loans just got paid off just a couple of weeks ago.
Wow.
And they said, we're thinking about doing this to finance our daughter's education.
Wow.
So you see, they've been through it now. They get it, right? Resource when laid off.
Mm-hmm.
Okay. We don't know. Can you protect against unemployment?
I mean,
there's unemployment insurance through the business, but that's really the only way other than to build your own reserves. Why not have this as a backup if you had to, right? Pass on structure to children. Jason's talked about that. There are a lot more we could get into there. Avoid lost opportunity costs with automobile purchases. Probably Truth Concepts is good at the best at that, at pointing that out or explaining that. Secured personal loans. And who's in control? Under what parameters? Yep. Business loans. Financing education. Provide bank collateral. This goes back way before I knew anything about any of these things. I had a customer in Iowa went in and collateralized his life insurance to get money to buy more cows.
Cows. I have a cow story too. That's funny. Yeah.
Who'd have dreamt?
Yeah.
Right? And also investing. So these are just some examples. I have another client who owns a automobile lube business, and he had an opportunity to buy it from the man. He owned the building, and he had an opportunity to buy the actual business. He called me. What did we do? On this case, he borrowed half the money from the bank and half from his life insurance. Nice. And which half was he in control of? The parameters.
Yes.
His life insurance loan.
Insurance. Yep.
And he's paid it all back, and it's tickled pink. I mean, it's very little work to it, right?
Yep.
So I just wanted to give some examples.
These loans do bear interest. Well, if you now have an interest rate you're paying on the loan that's greater than the dividend that you're receiving on the policy, it does not work. It falls apart.
The Money Guy show with Brian and Bo, they just didn't get into these things.
Right.
And this is part of the bigger picture.
I think one of my critiques of they didn't even really factor this in. So they're talking about loss opportunity costs, or talking about the difference of earning, and it's very black box. It's like, of course, it's like we're not idiots, okay? And maybe some people are, but it's just like, yes, if you're earning 3.5% over here and you could earn 8% over there, of course, you're not even factoring in that you have the ability to earn that same 8% if you really wanted to, if that's the assumption that you wanted. And yes, would the 8% still be ahead because if you factor in the loan cost? Yes, but then we don't even talk about all the other benefits, but you're a lot closer. And so I think whenever someone attacks something like infinite banking, they're not factoring in the talking points, at least of like being able to use your money. It's like, it really loses me, because then it just comes down to insurance versus investing. And It's like, insurance is not an investment.
Yeah. So one example they give is, they critique those who say, well, putting money in a 401k is like putting it in prison. Well, after you just went through this list about ways to use capital, I would agree with that statement. It is like putting money in prison. Mm. You can get money out of a 401k with a loan under their parameters, under their payback schedule. Let's not even get into the tax ramifications of what ends up happening in that particular case, but it just doesn't give you the control. Age 55 or 59 is when you have to wait to, depending on the plan document, when you have to wait to have liquidity under a 401k. So I wanted to spend a little bit of time, Caleb, because I wanted to tie it back into your book.
Okay.
Because there are some things here that I think are a part of infinite banking that were not brought up, that you do an eloquent job of covering in your book. An asset, right? Mm-hmm. So I call it LUC. That's short for luck. Liquidity, use, and control of your money. Mm. Those three things are extremely important. You lose opportunities without those three. The other is you also covered the need for capital and the value for having access to capital. Yep. And you get into debt versus collateralization and what's the difference. So I've got this next screen up, but we talked about it briefly. Again, the reality is you lose whether you pay for something in cash or if you finance it.
Yes, you're either paying interest or losing interest.
So I want to go back to a couple of quotes of Brian and Bo on the Money Guy show. You'll have an opportunity here to hear those.
And we didn't pull any money out.
Now, they make the comment about, well, we didn't pull any money out of the life insurance. So they're positioning it that we've allowed it to stay looking as good as it possibly could, right? And so they're building this case.
They're giving the benefit of the doubt.
Benefit of the doubt, right? Which, I mean, is used all the time. But again, I'm going to say this implies that they don't really understand what's being done with infinite banking.
There were no loans taken out. So the whole point of infinite banking, of banking on yourself, is that I can use myself as a bank instead of having to use the bank. Well, if you do that, all the numbers get smaller. They go down.
Now, I know in the IBC world that you might let interest compound, right? And I can see validity to that. In the LEAP world, we would say at least pay your interest every year. Mm-hmm. So if you're paying your interest on the loan of money that you've borrowed from the general account of the life insurance company and used your cash value as collateral, if you pay the interest, guess what you do to the performance of the product over time? Absolutely nothing. It keeps going as though you had never borrowed money, right? Now there's still an outstanding debt, but all the things that they're referring to would not be slowed up. Right. Because you've made your interest payment. So I think that's important to point out. Now, I think it's important to also talk about the compound interest curve a little bit in this discussion. So the reality is, in most tools, if you pull money out to pay for something, an opportunity arises. You have stepped off of the compound interest curve of that tool, and you've started a brand new compound interest curve in the new tool. When you're borrowing against the life insurance, the collateral of the life insurance, when you're using the collateral of the life insurance policy and you're paying the interest, you stay on that exact same compound interest curve. You haven't slowed it up. Now, I also want to point out something else. There's actually two compound interest curves working in your favor. There's the cash value and the death benefit. So when you borrow against life insurance and pay the interest, you're allowing both of those curves to continue right from where they are. You're not slowing them up. You're not backing up at all. That's an important thing to consider. So remember in our discussion, you can't have your cash value and your death benefit too. And I kind of said, well, yeah, maybe, but maybe not. Remember that some of the talk we've had about retirement income planning? If I can keep that death benefit growing, it gives me a permission slip to, guess what? Spend more money of my other assets and enjoy them when I retire.
Right.
You see?
Yeah.
So to keep that compound interest curve going is important too.
I love it.
All right. So let's just summarize a little bit about the life insurance loan. And as far as I'm concerned, we can wrap this section up. There is no reason to disclose what that loan is for. Do you know of any bank that will let you go in and borrow money and not avoid telling you what it's for?
No.
All right. There is no underwriting. You go through no application process. There is no payment schedule. You're in complete control of the financing and how you repay it back. It does not appear on a credit report.
It's big.
It does not add inflation from a banking issue in terms of new money. So all of those things are important, I believe, when you consider where am I borrowing money? And these things can be huge.
Yeah.
And that money is in your hands very quick.
I love it.
So that's what I got to say on this one.
Love it. Cool. Good stuff. All right, so this next section you call compound interest curve and efficient financial plan.
All right, I think it's important that we spend some time learning about the compound interest curve, because if we are going to participate in the curve, we have to understand kind of how it works.
Right.
And the importance of the length of the curve. And then I want to bring it back to some diagrams I have created that I think will help kind of put this in perspective. So I'm going to define this first picture diagram as what I call a normal compound interest curve. Now, why do I call it normal? It only has three phases. So the startup phase, the accumulation phase, and the acceleration phase. Now, startup phase, you basically are only what you've put in is going to be there. The accumulation phase is where we just start getting some acceleration from rate of return, and we really don't experience any of the upside from money earning money until we get into that third phase. So in a standard or normal curve, I'm just going to define this as 3 10-year segments. Fair enough? Now, I would say for most Americans, now there's exceptions to this, but let's just think about this a little bit. How many Americans start putting money away at 20?
Not
many. How many do at 25?
Not many.
How many at 30?
Probably starting. Yeah.
Remember the Dave Ramsey example from age 20 to 70?
Yeah.
It's not even rational.
Right.
So let's just assume that somebody really is committed to this at 35.
Okay.
How many years have gone by when they hit 65?
30.
30 years. You see where we are?
Yep.
So this is why I'm going to call it a normal compound interest curve.
Okay.
Now, in some cases, maybe it's 35. Maybe the exception to the rule is it's 40. But let's call this a standard curve. Now, let's start looking at what happens to that curve when we start going out for more decades. Now, in Dave's example, he used a
12%
return over 50 years.
Yeah, it's a big curve.
It's a big, long curve. But there is the potential to leverage long curves if we do this right.
Mm-hmm.
And so the importance is to understand the value of the curve and then what can we do to stay on it.
Okay.
So you'll notice with this whipsaw effect almost, what starts happening with exponential growth as we move into that fourth and the fifth stage. So I'm going to call the fourth stage the explosion stage. I have no idea what we would even call the fifth stage.
Yeah.
Okay? So it's important, I think, to understand that as a starting point. Now, I have drawn this graph as a way to describe what I call traditional black box financial planning. And then what I'm going to do is we're going to break down and we're going to talk about some of the assumptions or lack thereof that are used here. You haven't seen my next graph yet, but I want you to observe something, and this was done intentionally. This is choppy.
Yes.
Everything is isolated.
Yes.
Why? Because it's
Black
individual
box.
boxes
Yes. Yep.
designed to project some future value. Now you notice in the debt thing there on the bottom,
Yep.
I did that to have fun with Dave Ramsey, pay off your house in 15 years, right? So you see how
Okay.
that's being paid off. Now you'll notice the top one, the red one, is the IRA or the qualified account. Now you notice, where does most of the growth occur? If you look at this and study it, you can see dotted lines in the background and on the floor.
Mm-hmm.
You see the segments of the compound interest curve. So we're assuming there's three main segments. So again, your main growth occurs in that third phase.
Mm-hmm.
Now, I want to give you another example of something to pay attention to. Look at the college graph.
Yeah, I see that. It drops off.
You haven't even entered
Retirement.
the third phase of the compound interest curve, and you're already pulling money out,
Right.
right?
Yeah.
So why on earth are we even talking about compounding interest when it comes to something like a 529 plan? Remember the numbers I showed you before? It could end up you don't have anything more than what you put into the thing.
Right.
Now, in likelihood you will, but it could be that you don't.
Right.
Okay? The key is you're not leveraging a curve. So this is where in some cases you will see people use the life insurance cash value to finance the education, or do things like take money out as collateral, buy a rental property, let the son or daughter be the property manager, charge rent from their friends to live in the house, and then they've got all kinds of options, including maybe paying off or selling the house and putting all the money right back in the life insurance. But what did we not give up by doing that? We stayed on a compound interest curve.
Yes.
Okay, so you have to start thinking about, how do I stay on these curves? Now, the interesting thing with this is that you've got a plane there. You see a plane takes place at full retirement age or normal retirement age. I call it NRA here. That's not the National Rifle Association.
Yeah. Okay. Good.
Normal retirement age, you reach a plane. Now, what does the financial industry generally teach? You start withdrawing off that portfolio. So you'll notice here, do you notice my different arrows?
Mm-hmm.
And so it all depends on what we assume for rate of return assumptions, how much we can safely withdraw off that portfolio. And we could again spend hours debating that one.
Right.
But the key is that's the primary strategy. So we've got the accumulation phase and the distribution phase. I've got death at the end. We're not even talking about the third project, right? Just the first two. You'll notice what's on the left, term life insurance and disability insurance.
Yep.
Carry you through up to that point, and then they're gone. One other thing that I find interesting is, what do you do about the financial shocks of long-term care? Well, the solution has been historically, well, at about 55 or 60, you buy long-term care insurance.
Right.
Well, what does that do to your total wealth building? Now, I'm not saying that's not a better tool, but I'm also going to say that can be incorporated more efficiently in the life insurance planning too.
Yep.
Can't compare the coverage, apples to apples. So now let's talk about that graph, and I want to just summarize the things that are not considered. The length of a compound interest curve. Coordinating various tools. I purposely isolated them as separate entities. Liquidity, use, and control of your money.
Luck. Yeah.
Luck. Lost opportunity costs. It's totally ignored. The extra benefits you pick up by owning life insurance and other tools. The economics of every financial decisions. The risks that you're having to take by taking an investment-only approach.
Right.
Flexibility along the way. Volatility of markets. And finally, the flow of money. Now, if you can flow money from one product to another or one strategy to another, you can't do that in black box planning, as we've talked about. So that's how I'm going to summarize that. Now I'm going to talk about an integrated approach to financial planning. And this is where the life insurance comes into play. Now, from an aesthetic standpoint, what do you notice about this graph?
It's all interconnected.
And
you have this thing called VOM that seems pretty cool too.
Velocity of money.
That's right.
Now, and you and I have talked about this, Caleb. I think the consumer fits somewhere on a spectrum of way to the left or way to the right. Everyone, I think, can take advantage of velocity of money.
Yep.
The question is, how much will they do it and what's suitable to them?
That's right. Not everyone's going to be as entrepreneurial as, so it depends on your rate of opportunity.
Yep. And so that's why I've got it right there.
Got it.
All right. It overlays everything. Now, you'll notice the death benefit starts, and what does it do? It grows.
Yes.
We've got a compound interest curve lasting how long? 30, 40, 50, 60, 70. You see what I'm getting at?
Yep.
We've got a cash value that's in green.
Yep.
What's it doing?
It's growing.
It's growing, and it's participating in a long-term curve.
Yep.
All right. We have qualified assets, still acknowledging them.
Yep.
But what do we see different about the qualified assets now?
Curve is a lot more curvy than a
We're
drop-off.
spending and enjoying.
Yes.
What about the non-qualified assets? We're spending and enjoying them. Now, you see we've got home equity in there too.
Yep.
And you notice now the dotted lines in various places.
Yep.
These, to me, I'm going to, for the sake of this discussion, put those in the backup strategy box.
Okay.
Or category. So we can use the reverse mortgage right away at retirement.
Right.
But let's say that we don't need to, we don't want to. Maybe we implement it right away because it makes sense to do so, but we don't actually start using it till later in life. You see where I've got it coordinated here? When we've spent all the other assets, we still have backup plans. I can go to the reverse mortgage. I can go to the cash value.
Yep.
I can go to the death benefit. I can go to the dividends. You see, I've positioned it inside of a long curve as a backup strategy if necessary.
I love it.
And leveraging the compound interest curve on all of it.
I love it.
On those things, not the investments.
It's powerful when you can integrate something. Even the picture itself is a lot more clean. And it just is, this picture is still confusing, and there's a lot of moving pieces, but it just shows that if you can look at all these things put together, that's what true planning should be.
I believe the LEAP model does this, but it doesn't give us one picture to look at to explain.
It gives us a bunch of boxes. Yeah.
Well, yeah. Okay, so let's summarize this. This is economic based. So Bob Castellone, I believe, started the economic-based planning movement. And now we've got Circle of Wealth, we've got Truth Concepts, we've got Wealth Building Cornerstone. They're all based on economic principles. It utilizes efficiencies. It minimizes risks because we can minimize the amount of dependency on investment rates of return. So therefore, it's rate of return independent.
Right.
Okay. You can consider lost opportunity costs in all of your financial decisions. It increases or leverages longer compound interest curves. It increases flexibility. It improves liquidity, use, and control of your money, and it allows for multiple uses of a dollar.
Yes.
And multiple retirement income sources are available for you to pick and choose from, and you're in the best position possible at normal retirement age to implement a number of them.
Powerful.
So it's all, to me, about efficiencies.
So efficiencies and it's impossible to be efficient if you don't respect the compound interest curve, because part of being efficient is maximizing the compound interest curve as long as possible. And in your case, when you talk about black box financial planning, the idea of making decisions without looking at how they integrate, it's impossible to maximize the compound interest curve, because there's a lot of scenarios that you are not even factoring in.
If I'm doing the withdrawal method off of a portfolio, is the compound interest curve still working in my favor? Not if the research says that over time safely you can withdraw 4% and you're withdrawing 4%.
It's interesting. If you factor in, going back to the example that we use, the annuity, the life insurance and investments, you factor all those things together, that's an example of maximizing the curve. Like the volatility buffer is an example of maximizing the curve.
Investments.
When the investments are down, you tap into something that's not affected, you let it recover instead of taking money out when it's down. So I very much resonate with what you're saying.
Okay. That's my summary of the
awesome
black box diagram and the efficient financial plan.
All right, now we're going to talk about knowing when to delegate, and I'll let you just take it from here around why this was even a talking point that you had going into us recording.
Sure. So I'd like to use this to kind of position, I think we all have to acknowledge when we're over our heads. And also I would like to use this as our wrap up. And I think it's a good way to kind of summarize what I see as, I'm going to call them generalities in the financial planning community, but then also some that we picked up here from Brian and Bo in the Money Guy show. So with that in mind, what I want to do is I want to go to the CFP board, and we're just going to simply read this. This is the section in our code about competency. So a CFP professional must provide professional services with competence, which means with relevant knowledge and skill to apply that knowledge. When the CFP professional is not sufficiently competent in a particular area to provide the professional services required under the engagement, the CFP professional must gain competence, obtain the assistance of a competent professional, limit or terminate the engagement, and or refer the client to a competent professional. So I want to tie this in now to someone else that I dearly respect in the industry. His name is Richard. He goes by Dick Weber. Dick Weber was the host for the Society of Financial Services Professionals continuing ed video series for years. So this goes back to Des Moines, Iowa days in the 90s when I was going to these video. They were broadcast in, and we would pick up 3 hours of continuing ed. So I've known who Dick Weber is for years. A consummate professional. He also was the national president of the Society of Financial Service Professionals for 1 year. And today, he still runs a business called the Ethical Edge Consulting. So what he is paid to do is analyze life insurance. And how would we do that? Well, consumers would come to him. I had one case where I pulled him in because I had a CPA wanting me to evaluate a $5 million dump into a product. So I pulled Dick in and relied on his expertise to help me. He's called in as an expert witness. Now, I'm going to basically share with you Dick's comment. He said, CFPs should not be giving any life insurance advice from a fiduciary standpoint unless they have had additional training in life insurance. Dick Weber feels personally that the CFP program does not dig deep enough into life insurance for a CFP to even be providing life insurance advice. So I think it's one thing here for Brian and Bo to be covering this in a video, but I think my warning to them would be you probably shouldn't be engaging in insurance advice based on what we're seeing here. I mean, I hate to be blunt, but I think we've built a case that I don't think there's enough knowledge here to be providing advice. That's my opinion. Now, I've got to be very careful because I'm not supposed to be criticizing other CFPs. But,
really?
But I think this is a concern I have in the industry.
Right.
Is we need to wake up to this.
Well, you could say the same thing about me, though. I make a bunch of videos. I don't have any designations. I have an insurance license. They have an insurance license. So what would your pushback be on just like the freedom of speech kind of deal? Is that different than the CFP? Like when you become a CFP, do you take on a greater responsibility of
if I did not have my, let's say, 65 license,
right,
and wasn't held a fiduciary, I'm held to a fiduciary standard simply because I have my CFP.
I see. So you're saying because you have the CFP, that almost creates a greater scrutiny for you to be able to call another CFP out versus like potentially calling someone like myself out who's got less credentials, because they I'm assuming at least one of them are insurance licensed.
I would suspect. It's a matter of respecting others in the profession. I think that's what it is. But this code of conduct is signed off on. What I just read to you, I have to agree to this.
Right.
All right? So I have to recognize when I am beyond my expertise and delegate that. This is why I can talk about estate planning from a standpoint of general public knowledge and what I am capable of talking about based on my credentials. But I am not an attorney. I cannot draft legal documents, right? I'm acknowledging this, and I'm turning it over to a professional attorney who has the competency to do it and is licensed to. So I hope that's maybe
that's
putting a bigger, broader picture on this. So what I'd like to do now is just start focusing on a number of clips in the broadcast to bring this home. So here's the first clip.
And then if you live to be a ripe old age.
Now you notice there that there was this interjection of talking about at a ripe old age, the cost of insurance rates going up. Now I want to back up a little bit. We've studied whole life, which Infinite Banking has talked about. There is no such thing as cost of insurance in a whole life product that is separated out. It is part of the entire product. And cost of insurance will not go up in a whole life contract because it was designed not to have cost of insurance go up. Remember, it was all amortized on day one when the product was put in place. All right, I'd like to share another quote with you, or another statement that was made.
Fees coming through, and then a portion of that every single year, every single month is paying for the insurance.
Now, in this, they talk about, well, fees are coming out every month to be paying for the life insurance. Yes, and those fees are based on net amount at risk. We covered that, right? But net amount at risk doesn't apply to a whole life contract. So it becomes evident at some point, I'm not so sure what we're dealing with here. So it becomes a little bit difficult to even evaluate it. This is coming from my vantage point, okay? We've talked enough, I believe, about whole life to understand the difference. Okay, let's listen to the next statement.
And then this is what you just alluded to. This money is locked into a complicated insurance product. So all of us can kind of understand, if I have my money in a bank and I have it in a savings account, I need to go get it. I can go get that money and I can get statements on that and understand what's going on.
You'll notice here they talk about this is a complicated insurance product. Well, that is true. I would agree with them that anything built on a universal life chassis becomes much more complicated than whole life. Does whole life have some complexities to it? Yes. But as long as we understand the base contract and what we can do with dividends, we're 90% of the way there, aren't we?
Right.
All right. Not true with universal life. So I would step back and say, really, it's not that complicated of a product. I think it's complicated because you do not devote time to it. So perhaps it is complicated when most of your time and energy is spent on studying investments. Now, I'm going to throw this particular time. I don't know of any wholesaler from any IMO or any insurance company that wouldn't be willing to come out and sit down with Brian and Bo and help educate them. You see what I'm saying? It's not that hard to get educated. There are plenty of people in the industry, especially our vendors from our insurance companies, who are willing to spend the time to teach and educate. It's a matter of committing the time to it. And is it complicated? Yes. But so is the investment world.
Right.
It's true. It just depends on where we want to spend our time and energy.
We're not doing this just to straight up just rip it up. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. What are things we left out to try to make this as rosy of a scenario for this situation as possible?
Darryl, we kind of stacked the deck in favor of infinite banking and tried to be conservative on the man to the mutant side.
So I want you to notice through this that what I consider almost a mocking attitude toward the life insurance, and we certainly pick that up in inflection of voice. It's almost like we're making fun of the life insurance. We're belittling it. And I'm going to come back to where we started. There is something that's magical about life insurance. There is nothing like it that will step in and pay a death benefit. There is no other product. So we start there, right? We have to acknowledge that it is a profession that is taken seriously. People are involved with it that are extremely professional, and there's opportunity to treat it as a respected product that provides value to humans in this country and other countries. So that's what I would like to just summarize as I saw the attitude and approach to this throughout the video. So with that in mind, now let's kind of go to my review.
Okay, let's do it.
And I've separated it into two things here. Now, some of what we pick up from Brian and Bo, the money guy, or guys. But some of it I chose just to put into a general observation of the financial planning community. And then I want to just pull a few out from Brian and Bo specifically. Number one, we've already acknowledged this. The financial planning community generally ignores lost opportunity cost. Mm-hmm. We have to acknowledge that. So this professional whole group of people, over 100,000 CFPs out there today, I believe, they're ignoring this. We have to just recognize that. They do not focus on how to participate in longer compound interest curves if they're applying a black box approach. Now, again, if they're applying cash flow-based software, I could see it in some situations where they aren't. So I don't want to say never. They operate primarily in the investment silo. And I'm going to just ask that you view it through my eyes, through experience, through testing, through periodicals, everything that I pick up on. That's primarily the focus. Not entirely, but primarily. There's generally very little knowledge about life insurance. There just isn't. There's little training on how to use life insurance. So I can't fault Brian and Bo here. They wouldn't have gotten any of this in their CFP studies, right? They dangerously compare life insurance to investments, which we covered in the rate of return video that we worked on. So now let's spend a little bit of time just reviewing some things I want to isolate about their evaluation of the IBC process. They use price and cost of life insurance interchangeably. We know now they are two different things. They view infinite banking as a product, not as a process. They do not apply rate of return assumptions equally. We saw that when we studied rate of return and we looked at how they took life insurance and then they immediately went into the investment world and how we can't just count on the kind of rate of returns that are stated. We know that they have somehow mixed up whole life insurance and life insurance built on a universal life chassis. I don't know where that came from. Maybe, again, they're repeating things that they've heard. And they must not understand the role of the terminal reserve in permanent life insurance. And hopefully what we've covered, we've helped everyone understand a little bit more about the role of the terminal reserves. So they perfectly fall in line with black box financial planning. I wouldn't expect anything more. And it appears to me, based on the comment about, well, at least with investments, you'll have the asset and you can pass the asset on, that they also haven't spent time delving into research on retirement income planning. So that's kind of my summary of the industry at large, and I think we're able to glean some of that by simply looking at this particular evaluation as well. All right, so I'm coming back to the title of their video. The title of the Money Guy video is Insurance Companies Are Lying to You, Infinite Banking Exposed. I'm not so sure in a single way have we been exposed to why insurance companies are lying to us. Infinite banking is a technique. It's not a product, right? They're focused on evaluating a product. So I don't know that they've really accomplished what they wanted to here. Infinite banking is one of those tools that can incorporate whole life, and there are plenty of others as well. So as I wrap up, I'm going to come back to Dave Ramsey one more time. I heard him say one time he's never met a financial advisor. Now, I can put myself in that camp because of my licenses, but he says, I've never met a financial advisor who recommends whole life insurance.
That's a strong statement right there.
Okay. So everybody that's listening to this video, if you happen to know Dave Ramsey, why don't you just let him know that you now have met a financial advisor who can recommend in good conscience whole life insurance. All right, and I think it's only fair to end on this note. I think we should let Brian wrap up our video.
It is all term. I just want to make sure, though, that people measure twice, cut once. And that's one of the things we're trying to do, is just give you enough information where you'll do a little bit more digging, a little more due diligence to figure out, how do I walk this journey and build the best financial life for my family so that I don't have regrets, that I don't fall into traps, and I don't get myself in a moment where I look back and go, man, what coulda, shoulda, woulda happened if I'd have just known there was a better way to do money. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team. Out.
If you've made it to the end of this video, thank you for investing the time. And more importantly, thank you for helping carry forward Dan Flanscha's passion for financial education. Whether this course changed your perspective or simply expanded your appreciation for the power of life insurance, we hope it equipped you to make better financial decisions with greater confidence. Dan believed education empowers people to live more intentionally, and we hope this course continues to do that exact same thing for years to come. Thank you for watching. Thank you, Dan, for the legacy you've left behind.